Yeah, so we all are here today, and today is more to learn the basic understanding about investing and financial markets, and what are the different instruments where one can invest and earn a return on it. Okay, so we'll start with Finance 101 in understanding that why one should invest the money in financial products. So why should one invest? So why we should first make understand about what is about these products, different types of products which are available in the markets, and which helps us in providing the return on it. So is the only motive that we invest because we get some return on those products? The main answer to this question is that why one should invest, because we all have different goals in life, right? We have mid-term goal, we have short-term goals, we have long-term goals, and to uh, to make this goal fulfill, we require certain amount of money, wealth, to fulfill those goals, right? And so to fulfill those goals, we have to accumulate the money. Okay, so once we accumulate those money, that money has to be kept somewhere, right? So for examples, we have a goal of, say, marriage goal, or we a children education goal, or a purchase of house, okay, or a retirement saving goal. So we have a different types of goals. Now, when we say purchasing of house or retirement house, it's considered to be a long-term goals. What is long-term goal? Long-term goal are basically a goals which are kept for, let's say, for which can be fulfilled over a period of years, like let's say more than 5 years. So these are called to be long-term goals. Now, to fulfill those long-term goals, we require to accumulate those money. So once we start accumulating those money, we require to invest those money somewhere, right? In some products where we can get a return on it. So for that, we will have different products, different asset classes where one can invest those money into it. So we not only have a long-term goals, but we also have a short-term goals in our life. तो शॉर्ट टर्म गोल कैसे हो सकते हैं, जैसे वी गोइंग फॉर अ वैकेशन, लेट्स से फॉर एन इंटरनेशनल ट्रैवल और फॉर डोमेस्टिक ट्रैवल. So this is can be considered to be a short-term goals. Or we have to further study, right? And for study, or we have to go out abroad for study or something of that kind. So that requires certain amount of money for that. So that is also considered to be a short-term goals. So to fulfill those short-term goals also, we require to have certain amount of money for that. And for that, we will be accumulating those money. So once we accumulate those money, we should also understand that where this money has to be kept. We cannot keep it idle with us as a in the format of cash or in the format of savings. Now, why we cannot do that? Because if we do that, we cannot fight the inflation, because each and every money has its time value. So what do you mean by time value of money? So when we say time value of money, it means that every money. So when I ask you one question, that if I have rupees 1 lakh, okay, and now I want to give you, I will ask you a question that if I have rupees 1 lakh, whether you want it now, or you will be, I will, or if I will give you after 10 years, is it fine for you? So your answer will be very straightforward, that you will be requiring now. Why? Because that 1 lakh value now will be definitely more as compared to that value of, let's say, after 10 years. Now, why this so? Because each and every time has its, each and every money has its value. So as the time passes, the value of money also falls. So take an example, a simple example of a dairy milk. Okay, now if you purchase a dairy milk 10 years back, the same quantity of dairy milk you will be getting at rupees 5. Today, the same quantity of dairy milk, you will get it at rupees 10. So it states that the money that you have received 5 today, you will not be able to purchase that dairy milk, right? Because the value of that dairy milk has got now to be 10. So you will be required 10 rupees for that. So if you have invested that 5 rupees 10 years back, you might have purchased the same dairy milk at rupees 10 today because you have earned the return on that money. So where you will keep those money, right? The second question will be that where we have to keep that money which we have received today. So someone might have get salary every month. Someone is doing a business, so he might be saving some amount of money out of that. So each and every individual has its own different goals, set of goals, and each individual has its own a set of earnings, right? So each and every individual have different earnings. Each and every individuals will have different goals. So as we understand the time value of money, so so what are the three important reasons that why we should invest? One is to fight inflation, right? Because the as we have taken the example of dairy milk, the dairy milk rate now has increased from 5 to 10, right? Because महंगाई बढ़ गई है, so महंगाई बढ़ गई है, then we say कि we have to same thing we are now purchasing at a higher amount. So in that case we have to get that thing with to get that thing after a certain amount period of time, we have to invest those money. So by investing one can deal better with the inevitable growing cost of living. So the cost of living also increases. So let's take an example of a house. 10 years back the property value might be rupees, a same area property value might be let's say 10-20 lakhs, whatever might be the case. The same property value, now same property you will not get at 20 or 30 lakh now, it has increased to 50 lakhs. So because the cost of living increases, so if you have invested the amount, you might have better without compromising your living, you can live on the same fashion what you have living in the earlier 10 years back. So if you have invested the amount, then only you can do so. If you have keep your cash or if your money as an idle into your saving account, you cannot fight inflation. So for fighting of inflation, you have to invest the money. Second, to create wealth. If you have kept, if you have अपने अगर अपने दिमाग में सोच लिया है कि मुझे पैसा इकट्ठा करना है, so what you will do, you will accumulate that wealth. So whatever you are getting a salary or whatever you are earning an amount, out of that 20 or 30% or 10% of the amount you will be keeping aside for emergency purposes or for your goal, like short-term, mid-term, long-term goals for whatever purpose. So you have to start accumulating now. As early as you invest, early as you start investing, the goals that you have decided will get fulfilled easily. So it is always advisable to start start saving early in your life so that you can fight inflation, your cost of living cannot be compromised, and you can fulfill your all goals, whether it is short-term, mid-term, or long-term goals. Because every goal that you want to fulfill will have its tag with the money. So money will be required for each and every goal to get fulfilled. So what will happen by investing, one can aim to have a better corpus by the end of the defined time period. Now, whatever time period, whatever the goal you want to achieve in the life, he'll have a defined time period, right? If you want to get retired, you can retire only after 60 or after 65. So that has a defined time period. So after retirement, you will require a fund to not compromise with your cost of living and just to get amount that you require for your day-to-day expenditure and to meet life financial aspirations. That means the goal that you have decided to achieve. So therefore, these are the three broader reasons that why one should invest. So where should you invest? The second question will be then where one should invest, right? So having figured out the reasons to invest, your next obvious question will be then where one should invest, right? So that there are different financial products that are available, okay, in the securities market, or it is available with the banks, or it is available with different various other institutions that are available in our country. तो आप जाकर वहां पर पैसा अपना जो है, जो आपने सेव करके रखा है, सैलरी से जो पैसा आपने सेव करके रखा है, या फिर आपने अपने बिजनेस से जो भी पैसे कमाए हैं उसमें से थोड़े पैसे आपने अपने गोल्स के लिए आपने जो सेव करके रखे हैं, वो सेविंग्स जो है वो आपको अलग अलग जगह पे आप उसको इन्वेस्ट कर सकते हो. Now why you are investing? To definitely to get certain return. जब आप सेविंग्स अकाउंट में पैसा डालते हो तो आपको एक 4% इंटरेस्ट देता है बैंक्स. तो हर एक बैंक का अगेन अलग अलग इंटरेस्ट रेट होता है, कोई 4% देगा, कोई 6% देगा. So you are earning that amount of money so therefore you have to say that कहाँ पर इन्वेस्ट करना है, राइट? तो कहाँ पर आप इन्वेस्ट करो, where will one invest, okay, and what are the returns one could expect by investing? So therefore it's very important that you should invest in those products, because every individual will have its own risk and return characteristics, okay. So for example, if you say that a young boy, okay, who has just started its career will have a larger risk as compared to a person who is at a stage of retirement. Now, why the young person can take more risk as compared to the retired person? The simple question is that that young person has its whole career to build up over a period of time, but the retired person cannot build up the career after he gets retired. So the capacity of taking risk of a young person is definitely higher as compared to a retired person. So each and every individual has its own risk and return characteristics. So someone will require a huge return, like let's say 20% return or a 30% return from investment a year. Someone will require only 5% or 6% return a year. Okay. So every individual has different risk taking capacity as well as the return taking capacity. So based on the risk return characteristics, there are different instruments or different asset classes that are available in the market that will depends on the individual's risk and return temperament. So what is asset class? When we are using the word asset class, what do you mean by an asset class? So asset class is nothing but a category of investments who has a particular risk and return characteristics. That means what? That if they have a similar risk and return characteristics, a particular asset or a particular securities if has a similar risk and return characteristics, that will be put in that bucket, and that bucket will be called to be as an asset class. Okay, so there are some very popular asset classes that are available, which are in broader categories, which we have called as fixed income instrument, equities, real estate, and commodities. So when we say fixed income instruments, it has a lower risk as well as lower return. Okay, so any fixed income instrument, we call it as a fixed deposit, which we call to be an FD, or different types of bonds. Okay, equities are those which are regularly traded in the market, okay, which are listed on securities market. Real estate are commercial properties or residential properties, okay, and commodities are gold, silver. So in these different types of assets you can invest. All these asset classes will have different returns. So if you talk about fixed income instruments, they will provide you 6 to 7% return, or let's say more than if you take higher risk, it will be 8% or 9%. Equities on an average will provide you 13 to 14% return annually. Real estate can provide you a higher return, let's say 20% or more than 20% sometimes. And in case of commodities, it has a very flat return, which called be similar to a fixed income instrument like gold and silver. So it's very important to decide in which asset classes you have to invest. And that will be determined based on your age, your risk capacity taking ability. So if you are a salary person and if you are getting a fixed income every month, okay, so how much amount of money that you can put on risk and put on investments. So that thing will determine your risk taking capacity. Also, your age is a very important factor on determining how much risk you can take. Third, also very important, what type of goal you have in your life to achieve. If it is very short-term goal and requires a huge wealth and you can take higher risk, then you should always invest an amount of money where there you will get higher return, but the risk will definitely be getting higher. So if the return gets higher, the risk will also get higher. It's a very direct connection between the risk and return. So higher the risk in an asset class, higher will be its return. So risk if higher, return also gets high. But a small variation in the return will have your huge impact on your wealth that you are accumulating. So if you are saying that I have to accumulate, let's say 2 lakh rupees, right? Over a period of time, let's say 2 years, I have to accumulate 2 lakh rupees. Okay, now currently I am monthly I am keeping aside let's say 8,000 of rupees. Every month I'm keeping 8,000 rupees, and in a 2 year period I require 2 lakh rupees. So how much it will be like if you are saying 2 years based on 8,000 every month, it will be 1,60,000, and 1,60,000 plus the rate of return you have to add on that. So that will make you a corpus of 2 lakh rupees. So you have to determine the rate of interest. So rate of earning rate will be, let's say 10%, okay, a year. So 10% a year means on what 8,000 rupees, 16,000 will be added. So it will not fulfill your goal. So you have to invest into a product where you can get a 20% return. So then it will fulfill your 2 lakhs of amount of rupees or more than 20%. So in that case, you have to invest in those products which can give you more than 20% return. But again, can you able to take that risk? That's the second question. If you can able to take that risk, then you can invest in those products where you can get more than 20% return, which is very less chances that you can get a 20% product in a year. So this is how you have to determine your goal, and based on that you have to determine. So any change, let's say if you have not earned 20% return in a year, then your goal cannot be fulfilled. So the rate of earning rate is very important in determining how much wealth you are required to accumulate. So therefore so you have to match your goals with your asset classes first before investment. So before investment only you have to match your goal with the asset classes, how much money you will be required, okay, in a future, and how much return that particular asset classes provides me is what all time value of money is here matters. So after I'll calculate that, but this is my goal, this is an amount of wealth that I will require. Every month I will deposit this much amount of money, this much amount of rate of return is this product is being providing me, and after 2 years or 5 years, this much wealth I will be able to accumulate, which I can fulfill my goal into. So all thing has to be predetermined before investments, and that is a very important. So therefore you have to have a knowledge about various products that are available into the markets, how much return they can provide, how much risk each product has, and based on that you have to start investing in those products to fulfill your goal. So what are the risk and return characteristics? Let's see in the next slide. So these are the different risk return profile of various financial products. So some of the investors are low risk investors, some of the investors are a high risk investors. Okay, so it starts from conservative to moderately conservative to moderately aggressive, aggressive and very aggressive. So some in its own nature, okay, an individual nature. Some of them are very reserved, very conservative. They don't want to put their money in risk. In life also, they are very conservative in nature. So they don't like to take risk in their lives. Okay, so they will invest in those products which are very conservative, which provides a very low return, but the money will be safe. Even I get 4-5%, I'm happy. Okay, why? Because they don't want to take risk. So what they will do, they will put their money in saving account, or they will put their money in fixed deposits, which can provide you 4 to 6% return, or they will keep in money on national savings certificates or into post office or something somewhere. That is called to be a cash form of keeping money, right? Because that money will never be get liquidated. It is easily you will be able to get that money very easily. The liquidity is very high, so you can get that money at any point of time whenever you require. Okay, so you will get amount 4% to 6% return. So this graph is about the return graph. So you will get when you keep money in saving account or in a fixed deposits, you will get a 4% return, and the risk is also very lower, 0% risk, because you always will get the money. It will never get defaulted. So the risk is very low, but the return is also very low. So those investors who are very conservative in nature, or those who are very now on the retirement path, right? Let's say 60, 65 years of age, and they don't want to put their money, whatever they have earned over a period of time, into risk, then what they will do, they will keep that corpus, whatever they have accumulated over a period of time, into a fixed deposit, and will take money out of that every month or every year, whatever, for their daily day-to-day expenditure, right? So these are the conservative investors. So generally conservative, you have to be conservative, but after retirement, not before that. It's a what generally you have to take risk at a very early age of your career. So if you start taking risk at a very early age of your career, then you can build a good amount of wealth into till your retirement. Because if you take a risk, you will get a higher return. So there are various instruments, like if you talk about bonds. So what is bonds? There are different types of bonds. Okay, so some of which is called issued by the government of India. So the government of India, RBI, issued different types of bonds which are called to be a GSECs, government securities, or by RBI is different types of bonds, or by the corporates also. So corporates also issues different types of bonds. Now these are the bonds which a particular credit rating agencies of India provides a credit rating to those bonds. So some bonds are triple A plus, some bonds are double A plus, some bonds are double B plus. Based on those ratings, the yields of the bond, the interest rates of the bonds will be determined. So if it is a triple A plus, that means it's a highly secured bonds. It will never get defaulted. Okay, but the rate of interest that these bonds will provide you will also be low. So how you earn those money on the bonds? It's simple, that you are keeping your money, or you're giving your money to a government or to that corporate, and they will give you an interest. Same way you loan. So when you take a loan from the bank, you give interest to them, right? And same way, when one when provide money to bank, or when provide money to a corporate, they will give you an interest on it. So when they give interest on you, interest on that product, it will all depend on what type of instrument you are investing in. So if you are investing in the government securities bonds, it's highly, it will never get defaulted. It's highly secured bonds. Government bonds are highly secured bonds. So they will not give you more than 4% or 5% return. Government will not give you more than 4-5% return. But if you are investing in a corporate bonds, which are low rated bonds, which can be defaulted by if the corporate will not function properly, or if the corporate will not fulfill your obligation because they don't have money, right? So in that case, they will give you a higher rate of return. So it will all depends on the rating of that particular bond. So if that bonds are lower rated, you will get a higher return because you're taking higher risk. So again, these bonds will provide you 6 to 8% return. It can also provide you sometimes 10% or 11% return, again based on the ratings that this bonds has. So government bonds are highly secured bonds, RBI's bonds are highly secured bonds, but whereas the corporate bonds with lower rating will be a riskier bonds, and therefore you will get a higher return on that. Then there is a real estate. Now real estates can be a commercial property or it can be a house property. So what you do, you are accumulating a wealth, right? Now you have a goal that I want to purchase a house, okay, but it is for investment, it is not for my residence, right? You have to invest somewhere, so you can invest in residential properties, or you can invest into a commercial property, or you can invest into taking up plots or something that way. Now what happens in the real estate property is that the liquidity is very low. Here you can, once you have taken a property, and if that property area or that plot area or that home property or commercial property, the area is not that well versed, you will not able to sell it very easily, because the amount of investment is also high here, as well as the people who want to take that property are also very not very easily available. So the liquidity is very low, the risk is high, because it's a huge amount of money that you require to invest in those property, right? Because it can be in form of commercial, it can be in form of home property, and it can be 30, 40 lakh, 50 lakh, sometimes it can be 1 CR. So it has a huge amount of investment that will be required in those real estate property. So the liquidity is low, and therefore the risk automatically increases because you cannot sell it off easily. So whenever you get an investor, it is not easy to get that investors who can invest in those properties. Therefore, the return is also very high as compared to your fixed deposit or as compared to your bonds. The return in the real estate is definitely be higher. So it's based on the risk return characteristics. So now in India, we have a different instruments which can also be traded on exchange, which we call as a real estate investment trust, REITs. Now these REITs are the products where it is now become liquidity driven, because you will easily find buyers and sellers, and the amount of money that you require to invest is also very minimal, like 5,000, 10,000 rupees you can invest in those securities, and you can buy a share of that. Now in India, we currently has three different types of REITs where you can invest those money into and can earn. So it is daily tradable in the market on the exchanges NSE and BSE. You can see where the REITs can be traded easily, and you can buy and sell it off, and you can earn the amount of money. Now these REITs shares are those corporates who invest into the properties, so they receive rent, and they give those rents to you through a form of profits. So whatever profits they are earning on rent, they will distribute to you, because these profits are distributed to you as you are the shareholders of those companies. So these REITs now are being traded on the exchanges, where it is minimal value, and you can easily get exit out of it. Therefore, the return also gets lower because the risk is lower here. So in India, we have Embassy Office Parks, REITs, Mindspace Business Park, REITs, now just recently Brookfield India Real Estate is also being listed on the markets. So this can be easily traded, and therefore the risk is lower, and therefore this is also called to be a real estate investments. So you can invest into the real estate through REITs also, which are traded on exchange. Bonds are also traded on exchange. There are different GE securities, government securities, which are traded on the NSE and BSE. Also, there are different corporate bonds and HI bonds, IRFC bonds, which are traded on the exchange, where you can buy and sell easily. Okay, cash is in the form of fixed deposits, and all that can you do on in bank, PPF, post office. All this can be done in banks or in the post office account. Then there are hedge funds. Now hedge funds are very riskier, but it also provides you a higher return. What is hedge funds? So hedge funds are generally nothing but a pooled money. So they take monies from generally from an high net worth individuals who earns a huge amount of money. So they take wealth from those, they pool those money, and those money they put into an active strategy. They create some strategies in derivatives market. In those strategies, they put those money and earn an amount of return, and they provide that return to their high net worth individuals who have invested those money. by deducting their commissions, whatever the fees they charge. By deducting those fees, they provide that return back to their high net worth individual who had invested. Now these are called to be an basically they invest in those derivative markets, so they hedge those risks that they have. So they do use various multiple strategies, option strategies, derivative strategies. They use that and they earn a return on that, and they provide those return to high net worth. This is the role of hedge funds. There are a lot of hedge funds in India also who do such type of trading, but it's highly risky, and therefore the return are also very high. Then there is a private equity. Now in case of private equities is nothing but a startup funding basically. So any particular investor who has a huge amount of money, okay, and they want to invest money somewhere. So what they will do, they will do, they will see that this business is doing good. I will invest this money. Let's say he has 100 CR amount of money to invest somewhere, right? Now what he will do, therefore he will now some startup requires that amount of money. Say for example Zomato, Swiggy, or Byju's or whatever, tech startup or technology startup or any food delivery startups. So they require that amount of money, and that amount of money is there with that investor. So that investor will start investing that money in those startups, and that startup will give the return, that whatever return they are earning, give few percentage of that return to those to that private equity investor who have invested that money into that startup. So this is really very profitable in India today. A lot of startups are stealing some money from those investors, and these investors are getting huge amount of money from investment. But there is also a risk, because if that startup doesn't work, or if that startup fails to work, they does not generate revenue, then that amount of money, whatever has invested, is gone. So this is called to be a highly risky investment. It gives you more than 20 to 25% return sometimes, or sometimes it gives you 0% return. Therefore, the risk is also very high here. And not least but the stocks which are regularly traded into the markets in NSE or BSE stock exchanges, where you can buy, sell a particular stocks. So these are the different types of asset classes which we have been seeing. So we will learn in detail about what is equity stocks, also different types of mutual funds or different types of bonds. We'll have learned in other future slides. So these are the different ways in which you can put the money, and now all it will depend on your or will depend on the risk and return characteristics of each and individual which it suits to. So for some investors, bonds will get suited because they have their retirement saving a huge amount of corpus that they have accumulated over the year, and they want a safe return over a period of time till they are there. So after retirement till they are there. So to have that safer return, they will invest in bonds or they will keep in FDs. Or some young investors who just have started their career have certain goals in life, like they have marriage goals, they have children education goals, or they want to take a property somewhere. So they will start investing aggressively into the products where they will get a higher return, like they will invest in equities, they will invest in private equities if they have a huge amount of money, or they invest in real estate properties, so that they can get a higher return, and from that they can accomplish their goals. So generally investment in doing in a fixed deposit doesn't make sense, because for example, if you are earning a fixed rate of interest 6% or 7% fixed deposit, and the inflation in our economy is more than 7%, let's say 8% return and 7% return you're getting from fixed deposit, and inflation in the economy is 8%. Okay, so net off, if you do it, is minus 1%. You cannot even beat the inflation. Then there is no sense in putting the money in fixed deposit. So it's always to beat inflation, you should start investing in equities market, where you can beat inflation over a period of time. And therefore, because equity investment in generally, if you see historically also, it provides you around 14 to 15% return. Okay, so that is always a better chance, and the liquidity is also good there. Okay, the return is also good, the liquidity is also good. So it's always better to start investing in equities early in your life. If we talk about gold and silver, yeah, we do not have gold, but gold and commodities market, if you invest in golds and silvers, they are very relatively safer as compared to the other products. But again, the historical return, if you see on those gold and silver products, are not very encouraging. Recently, there is a spike of rates in the gold and silver because of the COVID structure. But again, investing in the gold and silver will give you very, very safer returns. But again, historically, if you see that they are not giving you they will give you around 4 to 5% return. Because once there will be a jump in the return, but again, it will remain flat for over a period of time, let's say for 10 years or 15 years, that rate will only move. So therefore, the gold and silver is historically provide you a not a very encouraging rate of return. So we have seen now various multiple asset classes and multiple risk and returns of multiple asset classes. And based on your goals, you will decide where to invest that particular money. But where you will do that? Okay. So for buying a fixed deposit, you will go to a bank, right? And for buying a bond, you will either go to RBI or either you will come to the securities market, right? For buying a real estate, you will have to find an investor or you will have to find a person who wants to sell, or for REITs, you have to come to the exchange. Same way for hedge funds, you have to trade on exchanges. For private equities, you have to find out the startups. For stocks, you have to come to the exchanges. So exchange plays a very important role in Indian capital market. So let's see how this uh, capital market in India is being structured and who are the different players, who are the different who are the different institutions who runs this capital market. So the structure of capital market is important to understand before starting investing. So you should know who are the players, who are the institutions, who are running this particular capital market, and what are the different types of markets that are available in Indian structure. Okay, so the next slide that we are talking about will be about Indian capital market structure. Okay, so generally in India we have two different capital markets. One we call it as a primary market, and the second we call it as a secondary market. Okay, now what is primary market and secondary market? We will have a different next slide on it in detail. What does it mean? But in general, when we say primary market, is a market where in start the corporate comes to exchange. So it is available in the securities market like NSE or BSE. The market so when we talk about NSE and BSE on the exchange, if a particular corporate wants to get listed into a market on NSE or BSE, when you can hear a lot of news that this securities is now listing on the exchanges. Okay, now a lot of you're hearing about LIC is getting listed on the exchanges. So what does it mean? They are listed on primary market, where you have to take a shares through a bidding way. You cannot buy and sell unless and until they are get listed. After listed, you can start buy and sell those markets. But before that, you have to bid a particular stock for buying. So that bidding process is called to be a primary market. That IPO is called to be the process of IPO is called to be a primary market. Whereas secondary market is nothing but a market where you can buy and sell a transaction very easily into the market. So there we call it as a buyers and sellers comes together and buy and sell a particular security at a particular price which is determined. So we have talked about investing in equities is an important instrument, right? Earlier we have talked about to beat the inflation. But where we should go and invest, it will be invested on the primary market or either to a secondary market. Same way when you go to a kirana store, right? Or a supermarket, what you will do, you will shop for your daily needs, right? Similarly, when you go to a stock market, you have to do a shopping of what? Of an equity investments. So for shopping of an equity investments, you have to come to a stock market. Okay, therefore the stock market is where everyone who wants to transact in shares, right? Who goes to transact. In simple terms, it means nothing but buying and selling. You have to come for buy and sell. So what you can do, if you want to buy a share of Infosys, let's say, can you buy it without a stock market? You can't. So for buying or selling a shares of an Infosys, it can only happen through a stock market. And therefore, the main purpose of a stock market is nothing but to facilitate that particular transactions for you. So if you want to if you want to invest into an equity markets, okay, you have to come to a stock market. So if you buy a share, the stock market will help you to meet the seller and vice versa, which is not easily available in private equities or into a real estate investments, where you cannot easily get the seller or a buyer. You have to go and say, call the brokers for that, right? The broker will come, they will give you that this is the property, this is the rate, this is what facilities are. So it's very much not very easy to get, right? Here, you can easily buy and sell a particular shares, and that facility is being provided by whom? By the stock market. Like a supermarket, unlike a supermarket which is in a brick and mortar format, the stock market is not in that format. It is electronically done, right? It's all electronically. You don't know who is a seller or who is a buyer. It's all done electronically. So if you want to buy a particular stock, you just bid it. You don't know who will be the seller, right? Who wants to take a particular share. So it's a very electronically way of format, and who all does that? It's not done by directly. We are not directly connected to the stock market. So if you want to buy a share or a sell a share, you have to do through a stockbroker, right? You cannot go and directly contact to stock exchanges. So it has to be done. So there are various intermediaries between that to transact into a stock market. So there can be a buyer, there can be a stockbrokers, there are depositories, there are custodians, there are clearing corporations, there are multiple institutions before going that order to the stock market. So there are multiple intermediaries between that before you buy or sell a particular stock. So which are we'll discuss stockbrokers in a later point with a detailed discussion about what we mean by stockbrokers. But there are two main stock exchanges, which is called to be a BSE and NSE in India, Bombay Stock Exchange and National Stock Exchange. National Stock Exchange is considered to be one of the main market of India, which has a huge volume in Indian market. 90% of the derivatives trades are happen in NSE. Cash market volume is also very huge in NSE as compared to BSE. So there are two different exchanges, BSE and NSE, where the people can go and trade in the securities market. Now, when we talk about primary and secondary market, this is done on the stock exchanges to buy equities. So there are different instruments on the stock exchanges called to be equity or debt. As we have discussed, debt means bonds. Okay, we have discussed bonds. We're talking about government securities. We talk about GSECs or a corporate different bond, HI, RFCs. There are different corporates who issues bonds. Also there are it will all depend they'll all have different credit rating. So if it's AAA plus, it's considered to be highly non-default bonds, but it will provide you a lower return. So this is called to be a different types of instruments that are traded on the Indian markets or Indian stock exchanges, and there can be a hybrid structure also, mixture of both equities plus debt. So these are the different instruments which are traded on Indian capital market. So you understand what the Indian capital market looks like. It talks about the stockbrokers, which divide into primary and secondary market, and there are different instruments that are traded on those stock exchanges. Now, who are the intermediaries of these stock markets of the stock when you want to trade? Which are the different agencies who functions in between the investor, okay, and till the time you are investing in that stock. So there are brokers. Now, what is the role of a broker? A broker are nothing but so whenever you want to trade into an equity market or into a derivative markets or into a debt market in any form into stock exchanges, you have to open an account in a particular with a particular trading member. And it can be a different broker. You might have heard about the names like Zerodha, Upstocks. There are different types of brokers, ICICI Securities. There are different types of brokers that are available in Indian markets. where you have to go and open an account. You have to do your all KYC's documentation and everything. And once you open an account through them, then you can start transacting. So you have to put an order in the broker account, and then that broker will transfer that order to the stock exchanges, and then only you can able to trade. So brokers plays a very important role into the securities market while you want to invest into equity. So there are multiple stock exchanges like BSE and NSE where you can start trading. There are multiple investment bankers. What do you mean by investment bankers? The role of investment bankers are nothing but to find the parties, what the investors, right, to invest an amount. So if, so say for example, if a particular corporate wants to raise an amount of money, let's say 100 CR, right? So where he will go? He will go to an investment banker and he will tell, I want 100 CR, please find an investor for me. So the role of investment bankers is to find an investors for that particular corporate and then give that particular corp. So that also plays a very important role in the Indian capital market. Why? Because they're facilitating the money to a corporate to run their business. So this is called to be one of the intermediaries through which a particular financing can be raised, the capital can be raised. So in the primary market, when we talk, the role of stock securities exchange, the role of exchanges is to raise the amount of money for the corporates only, right? So if a particular corporate wants an amount of money, they will come and do an IPO and they raise an amount of money through stock exchanges where multiple investors they will get who wants to invest in that company. Same way the investment bankers also do the same job, but with a very limited amount of people. Same way underwriters. Who are underwriters? Underwriters gives a confirmation a confirmation that if a particular investor does not fulfill, I will underwrite, I will give you a promise that I will take your shares. So if a particular company goes for an IPO, right? Then if they say that if that IPO does not get fulfilled, let's say if it is not fulfilled by 90% is only they get only 90% of investors, they don't get 100% of investors. So that 10% of investors will be an underwriter who promise that they will invest in your company. So these are the underwriters. The same way in the case of bank loans, there are guarantors. Same way in the stock market, there are underwriters who underwrites that in case if the IPO does not get fulfilled, then they will be the underwriters who will invest in that company. They will definitely charge some commissions, but again, that plays a very important role in the Indian capital market. So there are different various multiple intermediaries. There are also various other intermediaries, but these are the main broad intermediaries plays an important role in the Indian capital market. And who supervises all this? Who supervises all? Who supervises them? The supervision is being done by the SEBI, Securities Exchange Board of India, who supervises all their actions and deeds, what type of activities they are doing in the Indian capital market. So all these have been overlooked by SEBI. If there is any type of what we can say mis-selling, or we can say a type of frauds which have been determined, it will be on the in the watch of the SEBI. So when we talk about SEBI, SEBI is nothing but a watchdog, right, of all these intermediaries, whether it is a broker or it is a client or it is in players. So there are multiple players in Indian capital market. We'll have players who, so SEBI also keep an eye on the different players in the Indian capital market. So they keep an eye on intermediaries also. They keep an eye on the different players in the Indian capital market. Now, who are those players? The players are nothing but the CRA. CRA is nothing but a credit rating agencies. So we have multiple agencies in India where there are 3-4 agencies who provide the credit rating, right? ICRA we have. So ICRA will provide you a rating, right? So this ICRA, what they do, they do a due diligence of the company, how much loan they have taken, how much capacity they are, how much they are generating cash flows from their operations. Based on all those due diligence, they will give a rating to a particular corporate. Okay, they will give if that particular corporate is running very well, they have a huge cash flows, they can easily pay their interest on whatever they have borrowed, then they will get a huge amount, they will get a huge rate, they will get a good rating like AAA plus or AAA. So this rating will determine, so what will happen when they will get a rating, let's say if you are getting a very good rating, they can borrow the amount of money from the bank with a very lower rate of interest because the chance of default is less. Right? So whenever they issue a bond also, if the rating is high, if the rating is AAA, they will issue a bond at a lower rate of interest because the default is low. Same way, if they're getting a bad rating, let's say C plus or a D plus rating, then in that case they have to charge that the banks will charge them a huge rate of interest. They have to borrow the amount of money at a huge rate of interest, and therefore the rate of interest gets higher. So this credit rating agencies plays a very important role in determining whether that particular corporate will get default or not. Okay, so if a particular corporate gets default, you will easily able to identify through that rating, what rating that an agency has provided. So this rating agency plays a very important role in the Indian capital market. Okay, the players will be a corporate players. We have seen how the corporates will come to a market and raise the amount of money through IPOs or through issuing a bond and listed of the bonds in the market. Okay, there are multiple intermediaries which you have already learned about: brokers, investment bankers, stock exchanges, and underwriters. Then there are individuals who place. So we as a retail investors, we and you as a retail investors who wants to invest into a market, into equities, we also play into the market side. We buy and sell a transaction. So regulator keeps an eye on us also. SEBI keeps an eye on us also how we are trading. Either are we not manipulating the market or we are not misleading the market. So this individual also plays a very important role in the market because we are creating a demand and supply in the markets. Then there are banks and financial institutions in Indian capital market. So there are multiple financial institutions like insurance companies, like banks, who provides funds to corporates, which helps the Indian capital market to run. So there are multiple banks, financial institutions, which helps in running the market very well because they provides you a loan, and that loan will help us in having the money flow and supply properly. And there are multiple FDIs and FIs. So there are foreign direct investments. There are foreign institutional investors who invest into the Indian markets. So we hear in daily news that FDI have invested this much amount of money today, and financial institutional investors have invested this much amount of money today in the Indian markets. So when they invest into the Indian markets, the demand for the stock increases, and therefore our indexes also increase in the stock markets. So these FDIs and FIs plays a very important role to bring the foreign money into the Indian markets because we require that funds, right? To get demand from that funds, we require that funds to run the operations of the Indian market. So when FDIs and FIs puts money in India, it will help us in building more, will get more money, and therefore the operations will run very easily by the corporates. So also the dollar rupee rates will determine based how much money we are receiving from the foreign. So if the demand of rupee is getting higher, the rupee will get more strength. So this all plays a very important role in the Indian capital market. So Indian capital markets are generally run on this structure. So when we talk about institutions, there are domestic institutions like LICs and which you can rarely hear about it. And also there are different mutual fund companies. If you are, there are a lot of mutual fund companies like HDFC, AMCs, DSP, BlackRock, SBI mutual fund. So there are multiple. So when you talk about institutions, financial institutions, it includes LIC, it includes different types of mutual fund institution. When we talk about foreign institutional investors, they're nothing but a non-Indian corporate entities. So when we talk about foreign institutional investors, they're non-corporate. They are not Indians, right? They are they are foreigners who invest into the money. When we talk about credit rating agencies, there are ICRA, CARE. So there are different types of rating agencies that are there. There's also one more intermediary which plays a very important role in Indian market is depositories. Now there are different two depositories in the Indian capital market. One is NSDL and the other one is CDSL. Okay, so National Securities Depositories Limited is NSDL, and CDSL is Central Depository Securities Limited, which also plays a very important role. CDSL is listed on Indian market. Now what they do, whenever you buy a particular stock in the Indian market, right, that stock आपने कब buy किया है, जब आप किराना में when you go to kirana, you buy some rice or something, you bring it at your home, right? Same way when you buy a particular stock, okay, then that particular stock will go to your depositories account. Now you are the owner of that account, depositories account, but the depositories will keep that particular securities in their safe custody. Okay, so whenever you go and sell that particular stock, that will debit it from your account. So deposit is nothing but similar to a bank account, right? So when you particularly buy or sell a securities, they will debit it and credit it from your depositories account. Therefore, depositories also plays a very important role in debiting and crediting the shares that you have purchased or sold in that Indian capital market. So this is what we call as a demat account. So when you say demat account, you have to either open that demat account in CDSL or into an NSDL. So there are two different depositories in India. Like stock exchanges, we have BSE and NSE. Same way, we have two different depositories, NSDL and CDSL. Then there is also one other very important intermediary, which is called to be merchant bankers. Now, what is a merchant bankers? Merchant bankers' role is nothing but to facilitate the process of process of raising the capital. Okay, now if a particular corporate want to raise a particular capital, right? So they will go to a merchant banker and ask how I will do that, how I will raise my capital. So they will have the entire list, due diligence checklist. They will provide that to the corporate and say that these things you have to do, then you can raise the capital into. So the role of merchant banker is to comply, to make comply all rules and regulations to the corporates. They help in complying all rules and regulations. So these merchant bankers are different, like you can have Carvey, you can have Axis Bank, Edelweiss. So all are the different merchant bankers available in Indian markets who facilitate those rules and regulation compliances part for the corporates to raise the amount of money. So these are all different market players who plays into the Indian market. And then we'll talk about stock brokers, also an important player like Zerodha, ICICI Direct. There are different stock brokers. And also there are different portfolio managers. So portfolio managers are nothing but who manage the portfolio. If a particular retail investor does not know about does not know how the market functions, then he will go and open an account in the PMS account, portfolio management services they take. These portfolio managers who have a huge experience in the Indian capital market, they will give money to them and they will invest those money on your behalf, and they will give the amount of return to you by charging some amount of fees to you. So they are normally an investment advisors or a portfolio management services that who manages the service. So this also plays a very important role in the Indian capital market. So are we taking a break or we should continue?
We will take a 5 minutes break and then we will start again.
Okay, okay. Okay, so we'll take a break now for 5 minutes. So we'll rejoin after 7:05. Okay.
We are starting the session again.
Hello. Yeah, Paresh, can you hear me?
Yes, you can continue.
Okay. Yeah. So next slide. So we have understood the structure of Indian capital market. Now we will have distinguish between what do you mean by primary market and secondary markets. So as we've taken, as you consider, the Indian market has is divided into two categories. One is called to be a primary and the secondary market. Primary market is nothing but beneficial to an issuing organization. What do you mean by issuing organization? Means a corporate who want to come and get their shares listed into the Indian market. So who it helps to whom? It helps to the corporate entity who want to raise that particular capital. So who is the beneficiary for primary market? Is the corporate who wants to get listed. Similarly, in the secondary market, the beneficiary will be you and we. So what we do, we generally a retail participation or to any other player like financial institution or a financial investor or foreign investors who wants to invest into Indian market. So generally the investors who want to invest will be a primary beneficiary. So the shareholder or the investor of a particular company will be beneficiary in the secondary market. Whereas in the primary market, the corporate will get benefited. Why? Because they want to raise an amount of money into the markets. In the primary market, the objective is to raise funds, right? The corporate want to raise the funds, therefore they come to the market and raise it through a different investors. So when they bring IPO, when they bring IPO, what they do, they raise the amount of money. So if they want 100 CR amount, so they will come to Indian market, Indian stock exchanges, and they get listed there, and they will receive that amount of money to further expand their business. So that objective is to raise funds. The primary market objective of the corporate is to raise funds. When secondary market, the people come to earn return, right? To earn return. Now, how you will earn a return? The return will be earned through dividend format or through a capital appreciation. So let's say if you have buy a share of 100 rupees and tomorrow it will get at 105, you have earned an amount of rupees 5. That is called a capital appreciation. It has the stock has get appreciated from 100 to 105. So that is called a capital appreciation. But if you keep that stock for a long term, let's say for 1 year or a 6 months, and if the company announces a dividend, then you will receive a dividend also on that stock. So the main purpose to invest in the secondary market is to earn the return, and the return can be earned through two different ways: through dividend or through a capital appreciation. If you have invested into the equity stock, in the dividend, if you have invested into a debenture or a debt stock, it's completely different. You will earn an interest on it. Okay, or if you have invested in fixed deposit, same way you will earn an interest on it. So the objective of secondary market is nothing but a capital appreciation, whereas the primary market or objective is to raise the funds. So what is primary market? Primary market includes new securities such as initial public offering, that is called as IPO. So this is market which is established for a stock to get listed, whereas secondary market is nothing but a market where you can trade securities which is already offered to their marketplaces. So securities which already get listed, already offered to the marketplace, now to just start trading on that particular stock. So once it gets listed, now you can easily trade in the secondary market. Secondary market is nothing but like on the stock exchanges like NSE or BSE, where you can trade now that particular stock once it get listed. So this is a primary difference between the primary market and the secondary market. Now your question will be then why people come or why the corporates come and get their shares listed in the primary market. What is the reason why they do IPO, right? Why they want funds, or what is the reason for doing an IPO? So there are multiple reasons why a corporate wants to come into the primary market. If they are there, if they have their own set of corporate, if they want to have their set on ownership, okay. So why they come? So if the Reliance says that if I will only be the owner of my company, why I should give my stake to someone else? But there is certain reasons why a corporates want to give certain stakes to an investors. So 75% they will keep with them, okay, but 25% they will give to a investors. So 25% of the stake of Reliance is with some other person, with the investors. So so they come here because of certain reason. We come to the primary market because of certain reason. So the reason for coming to primary market by the corporate are the listed one. One is called to be a capex requirement. The corporates always requires funds to expand their business. If the business is doing very well, then they will always require a fund, right, to expand their business. Now the goal is now to start a company. That this is the capital that they have currently. On that capital, they want to start a company. They will start, and if it is growing further, they will definitely earn certain amount of money. Whatever the current money they will earn that money, and they will again roll that money into the business. But now they have to expand their business. They have to expand over a region, geographical region, or they have to buy a certain land or certain machineries for which they don't have money, right, to expand it, because they have seen that the profitability is huge. They're earning a good amount of profit. The client base is increasing, but they don't have money to expand. So for expansion of money, they will come and list their particular stocks in the markets. What happens basically, the process, how it happens for raising the money. So what they do, a particular company was already exist, right, in the market. That might be a private company, private limited company, where there are 2 directors or 3 directors. Okay, now they require a fund. So they first have to convert that company into a public company, right? Once they convert private into a public company, they will come and give their whole process, their objectives, what are their objectives, what the company does, who are the directors, everything in detail. Okay, everything in detail they will give to stock exchanges, the whole history, geography, everything of the business. They will give to stock exchanges, NSE or BSE, or to both exchanges wherever they want to get listed. They will give all the history to the stock exchanges and to SEBI. Once SEBI will weight those all thing, will see all those things, how this corporate is doing, and they give the approval to the corporates. Okay. Now this particular company get an approval for it, right, to get listed on the markets. Now they will come and get list. Okay, so they give certain amount of shares. Let's say if they have 1 lakh share, right, if they come currently, these directors are holding, or these shareholders who are current shareholders of the company is holding 1 lakh shares, 1 lakh shares, and they have to give compulsorily 25%. In Indian regulation, we have that 75% can only be held by promoters. 25% is to be held by another public if they are getting listed. So 75 and 25% is what our regulation says. So if they want to get listed, they can keep maximum 75%. The promoter can keep maximum 75%. 25% they have to give to the public. So this 25%, so if there is 1 lakh shares, total 1 lakh shares, so 75,000 they can keep, 25,000 they have to give to a public, to an investors. Now when they give 25,000 shares to a public, they will get certain amount of money from that, right, to the corporate, because they're selling that 25,000 shares. So this 25,000 shares, when they're sold, they get certain money, and that money they use for their expansion. So this is called to be a capex requirement. So they come here for increasing that particular, to get that capital from the public, to get the capital from the investor. Now why they do so? The 3 main advantage of doing that is that they're avoiding the need to raise debt, which means he does not have to pay the interest. Now, if he avoid the debt, he will not require to pay interest, right? And if he goes for an IPO, there is no interest charge, right? It's just amount of money raised, then it will be traded in the market. Based on the company's performance, the share market, the securities prices will move up or down. They have to just pay dividend. It's not compulsory also for the corporates to pay dividend. So dividend is also not compulsory. There is no cost. The only cost is to get listed into the market. At that time, they will have certain costs that they have to require to pay to a different merchant bankers, various intermediaries. They have to pay certain amount of money as a fees. But other than that, they do not require to pay an interest cost or something. And therefore, to avoid debt, they can take money from the banks, they can borrow the bank from the, but they have to pay every year or every month certain amount of interest on it. They have to pay EMI or they have to pay interest every year. So that to avoid that interest cost, they comes to the stock market to get their stock listed. So that's a very important advantage why the particular company does an IPO. So if it does an IPO, they come to the primary market because to avoid debt, to avoid interest cost, which affects their profitability, right? Second, it also important that it get exit to an early investor. As we were talking about private investment earlier in our slides, private equity. Now this private equity like Swiggy or Zomato, which are not currently listed on Indian markets, right? Now if tomorrow they decide that they want to expand their Zomato company, decide to expand their operations into foreign countries also, right? Now they don't have that much amount of money, so they decided to get listed onto the Indian markets. So now in Zomato, not only the person who have founded that company has an investment, they also have certain private investors who have invested, like Ratan Tata might have invested in Zomato or something. Now he wants an exit from that company. So how will get exit from that company? Now neither the promoter has the money to give to Ratan Tata that take money and get exit from my company. So to get exit from that company, Ratan Tata, what he will do? He will tell Zomato to get listed into the market so that I can sell my shares to the normal public who wants to buy our shares. So that will help an early exit to an investors. Okay, so who have invested the amount of money before listing, they want an exit from the company. They now want certain amount of money. Now the promoter does not have to fulfill, does not have money to fulfill that obligation. So they will get listed, and these investors who have already invested their money will get exit from that company. So that helps the IPO. The IPO helps in getting exit to an early investors. But very important, the fourth is risk sharing with promoters. Now, if you say 1 lakh amount of shares, okay, is been held by the promoter earlier. Out of that, 75,000 of the shares will be held by the promoter, and 25,000 of the shares will be given to the public. Now, let's say if a company is not doing well, okay, the promoter is only responsible for that 75,000 shares loss. So what he has done, basically the promoter has not only just given his profitability return to investor, along with the return, he also gives the risk. So he has shared the risk with the public. And that is the biggest advantage for the corporates, that they're sharing the risk now of the company with the investor. So how much risk you are taking will depend on the number of shares you hold. Okay, so if you're a 1% shareholder or a 2% shareholder of a company, you're taking a huge risk, and they are sharing that risk with you. The promoters are sharing the risk with you because you are taking certain amount of percentage of shares of that company. You are becoming the owner, a part owner of that company. So if you are becoming a part owner of that company, you are also taking the risk. So promoters are doing what? They are sharing the risk with you. And that is the biggest advantage for a promoter or for a corporate, to share the risk. And also it helps in rewarding the employees. So they generally issues an ESOPs to the employees. So once they will give a share to an employee. So whoever employees who works in a corporate, now they decided to get listed. Before that, they will give certain amount of shares to a employees at a discounted price. So if they are getting listed at 100 rupees, they will give at 95 rupees. So they are rewarding an employees. Okay, so because there they will allot a shares at an incentive rates, and which is called to be an employee stock option, ESOPs. Okay, so we call it as an employee stock options, where they will give the reward to an employee. And these are allotted on a discounted basis. Okay, so these are very few examples in international market. Also Google, when they have Google, Facebook, or any other, Infosys, when they have listed in the Indian market, they have given the shares to employees on an incentive basis. Not only they give at the time of listing, they will also give after the time after the listed, after the shares get listed in the secondary market. They give their shares to a employee at an incentive rate. So when you reward an employee, he will be there for a longer period of time. So the rate of attrition and everything will get reduced. So that also helps the company to retain their employee in the company. A good employee, they will reward through shares, which are listed on the market, which are easily tradable. So this helps in rewarding employees also. So once the shares get listed in the market, it helps them to reward the employees through giving them shares, which is called an employee stock option plan, which will give at a discounted rate, whatever the rate is existing in the market today, they will give at an incentive rate. And also it helps in improve visibility, because when it goes public, it increases visibility. Okay, because it has been publicly traded now. So whenever you go to a customer or to a vendor, you will tell them, see, my company is listed. Okay, you can see in the NSE website or on the BSE website, and my company is listed now on the market, and I'm doing very well. So it improves the visibility. It actually reduces your advertisement cost basically, right? So that helps the company because they have to, their cost of advertisement get reduces. It gets them the publicity basically, and therefore the public's interest start generated in that particular company. Okay, and therefore it creates a positive impact on their growth as well. So side on the right hand side of the slide, we have taken an example of DMart, Avenue Supermarkets, if you have heard it. It's about Radhakrishnan Damani's company. So if you have heard, it's recently listed in the Indian market in 2017. Okay, so how this IPO details is, just I have given you an example how the IPO details. So when you want to invest as a normal public, okay, because we are the public here, right, and the promoters is diluting its stakes to the public. So this when you want to purchase a particular share or want to in a primary market, what are the details that you look into? You look into when that particular issue is opening. So it will open generally in Indian market. We have 3 days opening of a particular IPO. So here it is March 8, 2017 to March 10, 2017. The IPO is open. So it generally opens for 3 days. Okay, the IPO is open for 3 days. In that 3 days, you have to put a bid for buying that particular stock, right? So you have to put a bid. So there will be a floor price which is determined. Okay, and that floor price, on that floor price, you have to put a bid. Okay, you have to put you can put a bid about that particular floor price also. So once you put above the floor price, based on the bids that the exchanges received, the price will be determined of a stock. So the issue type is a book built issue IPO. Now what does book built issue IPO means? This means nothing but a book is being built over a 3-day period. Over a 3-day period, the bids will come, a floor price is determined. Below that floor price, no one can put up bids. So you have to always put an auction price over and above the floor price, okay, or at the floor price. So this is called as a book built issue. Book built issue means the book is building over the bids and it gets subscribed. So if you have a 20 out of 1 lakh, if you have given 25,000 shares, that 25,000 shares you have to put a bid. So investors puts a bid on that 25,000 shares. Okay. Now issue size here is 62.5. It's around, I think so, 6 crore 25 lakhs 41,000 shares has been given as a bid. So when we talk about 1 lakh example, so 25,000 is what this shares means. 25% stake is what DMart has given to a normal investors, which value aggregately up to 1870 crore. So the DMart requires how much amount of fund? 1,870 crore. They have required that amount of money to expand their business. Now, how this rate has been determined, 1870 crore? It is determined based on the issue price. So what issue price they have? The issue price they have is 295 to 299. This is issue price is nothing but a floor price. So this is the price which is determined, that this particular price of a stock or floor price of a stock will be 299 per equity share. So you can bid in that particular range. This is a band, a price band, in which band you have to um, put a bid for buying a particular share. And the face value is nothing but it's a just to calculate the number of shares. It's a face value. So face value is 10 per equity share, and the issue price will be nothing but 295 to 299 per equity share. and the market lot. So if you are bidding, you have to bid for 50 shares. So one lot will be of 50 shares. So you have to bid on a lot wise basis. So if you're talking about bid, one lot will be of 50 shares, and the minimum quantity that you can trade is 50. So up to 50 shares you have to trade. Up to 50 shares you have to trade. Minimum is of 50 shares, means that means one lot. So one market lot is of 50 shares. Okay, so 50 into 2 into 300, if you do it, it's around 15,000 rupees that you have to invest. Minimum 15,000 you have to invest in a particular IPO. Okay, and it is listed in what? In BSE and NSE. On both exchanges it get listed. So 295 to 299 is what the floor price is determined. But when it comes to a secondary market, when it get listed, when it get listed, the price it will determine based on the demand and supply of a stock. So you will get surprised. So when the demand get listed on the market on a listing date, it has started trading at, it has opened at rupees 600, double the rate what they have issued. So if a person have invested at a stock at rupees 300, okay, he have put it a bid at 300 rupees. In a single day, when the IPO open, it open at 600 rupees. So that 300 rupees you have earned in a single, just on that day, on the listing day. So he can sell it at 600 rupees. So if you have bought 50 shares, so he had got 15,000 rupees. So 15,000 what he has invested, and 15,000 is what he have got a return. So 30,000 is what he has got a return on the investment of 100% return on a single day, on a listing day. So this is how the IPO function. It all depends on the demand and supply of a stock. So there are and also how much subscription that particular. What do you mean by subscription? So I will show you on the other slide that there are recent IPOs in India, and we have seen these are the recent IPOs that happens in India, and this is nothing but a subscription rate. So for example, if you have said 25,000 shares is what a particular investor has invested, right? That a particular investor can invest. Now you cannot say that you cannot invest, you cannot put bids more than that. So what does that, what will happen is that if you see an example of Mrs. Victor's Food Specialties, the first one, here the subscription rate is 198 times. So basically, if a particular share that a particular investor have invested, say want to a particular company wants to dilute its stake to 25,000, the investors can put bids at any amount of any amount. So it cannot be restricted to 25,000 only. The public can bid for more amount of shares, because you don't know who are putting a bid, right? So some particular investors can put more than 25,000 also. So 198 times means if a particular say a 10 shares is only available to an investor to invest, he has bidded for 200 shares. Okay, so that is 200 times is what a particular share have been bid for. So this is the amount of demand that an IPO holds. So each and every, if you have seen this, each and every stock have been bidded more than what the quantity is being provided by the corporate. So if a corporate is providing you 25,000 shares, but the bidding is being done more than what it provides, and therefore how then you will receive an shares. So in IPO you will not get always a chance to get the shares, because it happens through a pro allotment basis. Means if you have bidded, it is not necessary that you will receive a share. It is only through a luck that you will get a share. Okay, so it's not necessary that you will get a share. Okay, but you have to bid for that, and in bidding process also it is some of the shares are kept for institution participation, some of them will keep for a retail participation. And in that retail participation also, if it is overly subscribed shares, it will be determined through a pre pro rata allotment basis, where we call it as a lottery system. So there is a lottery system, and in that lottery system, if your luck gets, then you will receive a shares. It will only happen in case of the subscription is oversubscribed. In all these cases, in all these listed, this is Victor's Food Specialty, Mazgao, Burger King, Happiest Mind Technology, Temcon, Rosary, BioRoot Mobile, Computer Asset Management Services, SBI Card. In all these, Anthony West, in all these cases, it's all overly subscribed shares. So whatever the corporate have provided the number of shares to come to the investors, it's more than that the investors have bid it for. So in that case, it will be distributed on a pro allotment basis. The lottery system will play, and if you're lucky, you will get that shares. If you're not lucky, you will not get shares. So you have to bid for an IPO, and based on the lottery system, you will get a shares. And this is the way the IPOs are recent IPOs are working in India. A lot of interest has been generated amongst the investors. They invest in the IPO, and they want to invest in the IPO and try their luck to get the shares because the opening is very huge. So if you've seen, taken an example of DMart also, the price of a share is 300, but when you open it at 600 rupees. So on a listing day itself, you are earning a 100% return. So that amount of, therefore, that is an amount of interest that an investors has because they're earning a huge amount of return on the listing day. So this is how the primary market basically functions. Now we'll talk about the secondary market. Now primary market is something which called the corporate comes to raise an amount of money and also for various other reasons, to improve visibility, to reward employees, and multiple other purposes. And we have seen the recent examples in the Indian market how various IPOs have come and overly subscribed in the Indian markets. Secondary market functions very differently. So in the secondary market, stock market plays a very important role, right? Here there is an aggregation of buyers and sellers of a stock. Now, stocks means the shares, you are the part owner of that company because you represent the ownership on the claim. So once you hold a stock of Infosys or Reliance, you become a part owner of that. If you are holding even one share of a Reliance or a Infosys, you become an owner of that company because you are investing in that company. So you are buying that particular stock, and when you sell that stock, you no longer remains a owner of that stock, right? You don't become an owner of that company. You no longer become an owner of that company because you have sold that particular stock. So the process of this getting the company which gets unlisted, they will find an investors in the primary market, and then they get listed on the stock exchange. And once it gets listed on the stock exchange, then there are multiple buyers and sellers who comes and start trading in the secondary markets. So this generally all happens when electronic trading platform. So when it gets listed on secondary market, it will start on the electronic trading platform through a broker. So you have to go and start, if you want to trade into the market, you have to go to a broker. Nowadays it's all online, so you can open an account online like Zerodha, ICICI, Edelweiss, Upstox. So you can go and directly open an account, do your KYCs, and like just a bank account. So you have to just open a account through a broker and then start putting a bid at sitting at your home. You can just buy and sell a particular stock, just require an internet or a Wi-Fi. And once you get that, so you will start trading, put buy bids and sell bids. We'll see on a later stage how you have to use that particular trading platform for trading, the broker platform for trading purposes. So you have to just go and invest, and it's all electronically. You don't know to whom you are selling a stock or from whom you are buying a stock. So there are counterparties which you are not aware about. You will just buy and sell a stock, and this is guaranteed by a stock exchanges. Guarantee will be provided by stock exchange that you will deliver your stock into your demat account once you buy a stock, and once you sell a stock, it will get debited from your account. So it all ensures by the clearing corporation, stock exchange. There is intermediaries who plays a role in the clearing of the trade. So we'll have a later slide on how the settlement and clearing takes place in the stock exchanges. Therefore, a single share, even a single share of a stock, represents a fractional ownership of the corporation in proportion to the total number of shares. So if you're holding a 1 shares, then it will be according to that the percentage amount of ownership you will be holding. This typically entitles a stockholder to that fraction of a company's earning proceeds from liquidation of assets or voting power. So whatever fraction, whatever the amount of shares you are earning, you will be available for that profits of that company. So you will be the owner of that profits of the company. Whatever the profit of the company that the company earns, you will become an owner of that profits. So if you're holding only 1 shares, you will become a part owner of that profit that a company earns, and that will be given through dividend by way of a dividend to you. And also the voting power. So voting power also plays a very important role, because if you are a owner of that particular company, you will also have a right to vote on certain matters of the company or business matters of the company. So if a company, let's say, decided to appoint some director, new director of the company, you can vote, okay, on that decision. So you will be responsible. You will become a you can vote on the matters of the company. So these are the various ways in which you become an owner of that particular company through a stock markets, and that is only happen possible in secondary market. For trading in secondary market, you require a stock market and a broker to open an account. A broker will facilitate you to trade in the stock market. So this is how the secondary market will functions. So before you start investing in the market, you should also be aware about various jargons that are generally used in the stock markets. Okay, so you should not go and directly start trading before understanding different jargons, different phrases that are being used on the stock markets. So you all must be aware about multiple jargons that are used in the stock markets. Okay, but before that, we will recollect whatever we have learned till now. So the primary market is nothing, the how the process flows. Let's see. The primary market, the company gets listed through issuing IPOs, then the shares are distributed, and the secondary market trading begins. Okay, so the primary market is what? Nothing but a company get listed. Company, how it listed? Through issues an IPO, then shares are distributed to investors, and then the secondary market trading begins. This is generally a flow. Once the secondary market trading begins, there is a flow of funds and there is a flow of shares. So buyers will come, buyers will book trade through broker one. They will come to stock exchanges. The seller will also be coming through a broker two. They will also come to stock exchanges. So this is how the funds will flow. So the buyer will have to pay a fund to a seller. Seller will get a fund from the buyer. Then the flow of shares will also happen same way. Seller will give shares to buyer and buyer will take a share from the seller. But all this happen through a broker and stock exchanges. So this is how the structure of primary and secondary market holds. So what are the jargons that are commonly used in the stock markets? Okay, so these are the way of jargon, the different jargons that are used in the markets, which you should be able to understand. I talk about bull market. Bull market, people are saying that it's a bull market. What do you mean by a bull market? So if you believe that the stock prices will likely to go up, right? You are bullish on that stock price. If you are thinking that today that price will go up because of certain news, yeah, or you are saying that this stock is bullish in nature, that means that the stock prices will go up. Therefore, we call it as a bull stock. We call it as a stock which is very bullish in nature. But when we say a bull market, entire market is bull, we generally talks about the stock market index, right? We talk about a Nifty 50 or a Sensex, BSE Sensex. So when we talk about bull market, we talk about a index that will go up. We are likely to go up today. The market is going to be a bullish because of certain amount of news or something. So we are talking about here Nifty 50 or Sensex. That's generally about the index, stock market index. And talk about stock bullish, we say it's a bullish stock, which will, the price of that particular stock will go up. Opposite to it, we call it as a bear market. where we are believing that the stock prices or the stock index will go down, and therefore you are bearish on that particular stock. Okay, same way the trend. When we talk about trend, so what do you mean by a trend? Trend means nothing but a particular way in which a particular stock will move. Okay, so if you are saying that, or we can call it as a general market direction, that over a period of time, let's say for example, from today onwards, the market will go up for a few period of time. Because of coronavirus, the trend is now to a downward trend. So this is how the people judge the market, through a trend. So if we have earlier in last year, if you have seen, uh, the market has significantly fallen in the March period. From 15th March onwards, the stock market have fell significantly because of the cases of coronavirus spreading all over the world. So there is a trend, there is a bearish trend. The stock market has fallen over a period of time. It's a market direction. Basically, it talks about a direction of the market. Okay. So if the market is declining fast, the trend is said to be bearish. If the market is trading flat with no movement, then the trend is said to be a sideways trend. So there are different ways of explaining the trend also. So if the market is falling very fast, we say it's a very bearish market. If the market is flat, we say it's a sideways market. Now, what market? Market means Nifty 50 or stock market index. We're talking about here stock market index. So it will be a sideways market. And if the market is trending up, we say it's a bullish trend. So it all will depend on the. So these are the jargons that are used in the stock market. Now we talk about the face value of stock. Face value is nothing but a shares fixed denomination. It's a it's a price which will determine the quantity shares. So it used to determine the number of shares that are being traded in the market. Well, we divide the face value by dividing the face value. So the amount, when we divide by the number of shares, it's what the face value helps us in determining the number of shares. Then there is a 52-week high low. When we say 52-week high low means what? 52-week high is nothing but the highest point at which a stock has traded during the last 52 weeks. Okay, so in the last 52 weeks, that stock has never reached to that high, but this time that particular stock has traded at a very high rate. So if a stock have never touched in 52 weeks, 52 weeks is generally a 1 year, right? So in a 1 year, if that particular stock have never reached to 100 rupees, it's hovering around, let's say from 30 to 99, but it had never reached to rupees 100. Then we say that this stock today have reached to 100 rupees. It has breached to 100, and therefore it has now considered to be a 52-week high stock. Same way, 52-week low stock. That stock have never went to 30, but this day the stock has went to 30 from rupees 100. That means this stock over a period of 1 year. That means this stock is 52-week low. So that means 52-week high determines that the stock is very bullish. It will go further up, or it will say because of certain amount of news, the stock is doing very well. And whereas 52-week low means that stock is not doing very well. Stock is now will fall further, and because it marks the lowest point at which the stock has traded during the last 52 weeks. So this gives you a range. That generally 52-week high low will give you a range also. So when you calculate that in the 52 day the 52 weeks, what is the low point of the stock and what is the high point of the stock? This can also help you giving a range of that stock, that the stock is moving from which to which range. Okay, then all-time high low. Since from the date of the listing till the date of today, this stock has never reached to this high price. This is the first time that stock has reached to this high, that we call it an all-time high. From the date of the listing, from the date at which this price has reached. This is called to be an all-time high or all-time low stock. There's one more thing, which we call to be an upper circuit or a lower circuit. When we call it an upper circuit, what do you mean by circuit? The exchanges sets up a price band. Okay, each stock will have a price band. Some stock will be having a 5% price band, some stock will be have a 10% price band, some stock will be have a 20% price band, some other have a 2% price band. So stocks cannot move in a day beyond 5%, okay, or 10%, or 20%, or 2%, except the derivative stocks. So derivative stocks does not have a price bands. Okay, only the stocks which are non-derivative stocks has a price band. So the stocks can move only to that price band. So these are called to be a circuit. Now for all derivative stocks, there is a circuit of 10%, but if it crosses to 10%, they will flag that particular circuit and it go a further 10%. So it can move beyond 10% also. So there are no price bands for derivative stocks, but for non-derivative stocks, there are price band which is established by stock exchanges based on how securities is performing. So if the security is very highly volatile in nature and there are also different criterias, if they're highly volatile, then they will put that band of the stock to a lower, because the risk definitely it gets higher because if the stock is highly volatile, moves very highly up down, the stock exchanges will put filter to it, will circuits to it to a lower, like 5%. If the stock is doing very well, then they will put to, they're not very highly volatile, it's not moving very high. So in that case, the stock will be at 20% price band. So that particular stock in a day can go up or down 20%, but not beyond that. Or it can go up or down 5%, not beyond that. So that is the call of upper circuit and lower circuit. Means a particular stock can be in that particular band only. That the highest price of that particular stock can reach on the day is upper circuit limit, and the lowest price is the lower circuit limit. Okay, so if you can open a particular any stock, if you can search, you can easily get that this stock can reach to this level, not beyond that, in the above level, and in the lower level this can stock can, so if let's say assuming 100 rupees, okay, if a stock is at 100 rupees, then you will get an upper circuit. You can put a bid of that particular stock. You can buy at more, not more than, or you can sell a stock at not more than 120 rupees, because there is a price band of 20%. Okay, a circuit is of 20%, so you can sell it out only at 120 and you can buy it only at 80 rupees. So there is a upper circuit at 120 and lower circuit at 80 rupees. So this is where the price will move in a day. The price cannot go beyond 80 down, and it cannot go beyond 120 in the upper side. So it can move only beyond that, from 80 to 120 only. So there is always, each stock has a circuit, each stock has a price band, but it will always have a different price bands for different stocks. So any one stock can have 2% band, or one other stock can have 20% band. It will be determined by stock exchanges based on certain criteria that they have. One of the criteria is volatility. So based on the volatility of the stock, the price band is determined. This is for non-derivative stocks. For derivative stocks, there are no price bands. Then there is long positions and short positions. Long positions means you are going long, means you are buying a particular stock. Okay, so it gives you a direction to a trade. So if you are buying a stock, that means you are bullish. I am taking a long position, means I am buying a stock and I am bullish that the stock price will go up. So you are long. So if you are long on, let's say example, of Biocon shares, okay, so you are planning to go long on Biocon, right? Respectively, if you have bought the Nifty index with an exception that the index will trade higher, then essentially you have a long position on Nifty. So if you are buying a stock, that means you are a long, you have a long position on it. Same way, if you are going, if you are shorting a stock, that means you have a bearish mind. If you have a bearish view of that particular stock, and therefore you are shorting that particular stock. So these are generally a commonly used jargons that are you should be aware about when you are investing into a stock markets. So how is a transaction cycle looks like? So you will first have to decide a trade. Okay, you have to decide in which stock you want to trade. So you have to decide first, right? Before decision to trade, you are required to open an account to a broker, and that you will then decide which security, after your research, after your looking into the fundamentals of the company profile, or by hearing any advisors recommendations that you want to buy a particular stock, Based on that, you will decide whether I want to sell or whether I want to particularly buy a stock. You will decide a quantity, at which quantity how much quantity you have to trade, and also the price at which you want to trade. So the decision to trade is the uh, first cycle in the transaction you have to carry out. Once you decide to trade, then you have to place an order through a broker terminal. So you have to start placing an order in the broker's account, right? In the broker terminal, you have to place an order. Now there are different things that you have to look into while placing an order. You cannot go and simply place an order. You have to all decide the quantity, the price, in which exchanges you have to particularly trade, which securities you have to trade. So everything you have to decide and place an order into it. Once you place an order, there will be a buyer and seller meet, and the trade will get executed. Once this trade get executed, that means you have sell a particular securities, you have buy a securities, you will get a notification that you have bought this much amount of shares at this much price, or you have sell this much amount of shares at this much amount of price. Once the trades get executed, the multiple other institutional intermediaries will have to start their role. So that once the trade gets executed, the trades will get clear. Okay, so the clearing of trades will happen through NSSCL. Clearing corporations will clear your trades, the clearing member. So here the broker's role gets ended. Now the clearing member's role gets started. So the trades will get clear through a clearing member. Then your trades will settle. So the settlement of trades will happen through a clearing corporations. Okay, so the buyers will your amount will get the amount will transfer from your if you're a buyer, the amount will get transferred from your account to a seller's account, and the securities will transfer from seller's demat account to your account. So you will get a securities credited. So this all will happen through a settlement process. The trades will get settled. So from one demat account to another demat account, so the depositories also plays a very important role in settlement of trades. And then the funds and securities will move accordingly. So once the trades are settled, everything is okay. Then uske account mein, they have in that account their shares, they have in the account of money. Then the funds and securities will start moving. This is the final cycle. So this is how the transaction cycles functions in the securities market. So Paresh, can we take a break now, because the other one is the broker terminal. So okay, I hope so. Till now, I think so. We are very clear with how this basically the market is getting functions and different institutions which are available in the Indian capital market, and why one should invest, because there are multiple asset classes. So when we talk about primary markets, the primary markets, corporates comes for an IPO, and then they are traded in the secondary markets. And we also learn how the secondary markets, in secondary markets, what is the transaction cycles and what are the different jargons which are used in the Indian capital markets. And I hope this all things has it's been till now has been very clarifically understood to all the participants. So now what we are going to have is how one can buy or particularly sell a stock. So many first time investors, many first time retail participants do not know, or are not aware about, because they are from different fields. They have never traded in the markets, and they don't have any idea about how to trade in the Indian capital markets. So the very this is the slide that will help you to understand how to buy or sell a particular stock in the Indian capital market. First of all, you have to open an account in the through the broker. So you have to do all your KYCs and everything. So once you open your account through a broker, then you will get a terminal of a broker, and which you can view into your laptops and your PCs. You can view that terminal. Okay. So once you have viewed your terminal, now you have to make certain decisions to trade, right? So once you have viewed the terminal, you have to decide how much quantity you have to trade, which exchanges I have to trade, and where to trade.
हाँ, ठीक है. There will be a 5 minutes break and then we will continue the session.
Okay. Yeah.
We are starting the session again. There are two questions are there. Any possible, Chirag, there are two questions about any possibility that we can place order and stocks which are not available.
Place orders on?
We can place order and stocks which are not available in the exchange.
No. So you have to, so a particular stock has to get listed on the market. So once it gets listed on the market, then only you can place an order on that stock. So otherwise, it's not a possible only the stock is not available on the exchanges and you can place an order on it. So there is a possibility that say a stock can be listed on the BSE, but it is not listed on NSE. So in that case, you can only trade or you can put orders only of that stock on BSE platform and not on NSE. So I will explain you in detail about how you have to place an order in this particular slide.
Okay.
And
Other question is who decide the commission for clearing group?
Commission for clearing group. It's a fees, basically a clearing fees, which an exchange or clearing corporation has to decide. So if a particular trade it's been cleared through a clearing corporation, then in that case exchanges will decide. And in case if a clearing member, so it's a broker, right? Broker is also a clearing member. So in that case, a clearing member will decide its fees. So it's all depend on the clearing member and the clearing exchanges will decide the clearing fees for those. And it is been regulated by the SEBI. So SEBI is always keeping its eye on what fees the exchanges have been charging or a member has been charging that way.
Okay, you can continue the session.
Okay, Paresh. Yeah. So there is so we have seen till now primary market and secondary markets, how they function and what are the jargons that are used on markets and where you can invest. Now what we're talking about in the secondary market, how you can place an order or how you can buy or sell a particular stock. So you have to make certain decisions while deciding about which stock you have to buy after doing all the research, after doing all fundamental research, technical research, everything you are you are now committed that you have to buy that particular stock. Then you will come to a point where you have made a decision to trade. So what you have to decide? You have to decide the name of the stock, in which stock you have to trade. Now, as one question has been asked, whether that particular stock, if it is not available in the market, can we do a trading? No, we can't do it. So either it has to be listed on NSE or it has to be listed on BSE. So that name of the stock has to be listed somewhere, right? And based on that, you will decide that in which stock you want to invest. So investment in secondary market only will be done only if that particular stock is listed in the market. You can invest in any other company. Sorry, but the route will be different. It can be through an investment banker or through a private investor, private equity. So the route will be different. You cannot come to a stock exchanges if the stock is not listed on the market. You cannot invest in that particular stock. So you have to decide the name of the stock and whether that stock is listed on NSE or BSE. Let's assume that it is listed on NSE. So you have decided to buy a stock, this stock, which is listed on BSE as well as NSE, but due to the liquidity part, you have selected a particular stock exchanges, or you have got there at a price cheaper than BSE. Okay, so you have selected a stock which is listed on NSE. Then the type of trade. Now there are two types of trade that you can put. Either you can put cash to carry, that is called as cash stock, or you can do an intraday trading. Now I talk about cash to carry. Cash to carry means a stock where you are want for a longer term perspective. That means you want to carry that trade over a period of time. It can be 1 day, it can be 2 day, it can be 3 day. Means today you are trading, assuming 16th April. So today you are trading a particular stock and you want to carry it till tomorrow. Then you have to place a cash trade, which is called to be a CNC order. Okay, you have to put an order of cash to carry trade, where you can sell that particular stock. Okay, at the you can particularly, if you are buying today, you can sell that particular stock tomorrow or over a period of time. But you cannot sell a stock. If you're buying a stock today, you cannot sell a stock today itself. So in that case, if you want to buy a stock and sell it today itself, then you have to do an intraday trade. Okay, but if you want to hold that particular stock, you have to place an order called as CNC. Now in both these cases, the margins are different. You have to pay different margins for cash to carry trades. You have to pay a different margins for intraday trades. Margins means the money that you're paying for a trade. Okay, the money that will be debited from your account for buying a trade. So if you're trading for a cash to carry, you have to pay 100% margin. So if a particular stock is at rupees 100, you have to pay the entire 100 rupees as a margin for trade. But if you are trading as an intraday trade, you have to pay only 100. If the stock is of 100 rupees, you have to pay only rupees 20, because you know that the stock will not move beyond that, because every stock has a circuits. So each stock will have its own margin. Now margins will be decided. Each stock will have different margin. Each for intraday trades, each stock will have different amount of money that you are required to pay. Will depend upon the risk. There are various factors that will determine what amount of margins you are required to pay on that stock for that particular trading purpose. So each stock will have different margins for intraday trades. So if you are buying for a 100 rupees stock, you have to just pay 10 rupees or 20 rupees for that particular stock if you want to do an intraday trading. So for intraday trading, you have to pay you have to pay just lower margins, but the risk is also high. Whereas in case of cash and carry trades, you have to pay 100% margin. So if you are buying a 100 rupees stock, you have to pay entire 100 rupees. But for intraday, you have to just pay 20 rupees or 30 rupees or 10 rupees. Depends on the securities in which you are trading. So there is a different altogether. So if you are an intraday trader, if you like to take risk, then you can do a intraday trade because the margins are lower. In cash to carry, the margin is required to pay entire 100 rupees. Then you have to decide. So you have to decide which type of trade you are required to take in the market. Then the third one is a quantity. How much quantity you are required to enter. So if you are decided to take 100 quantity or 10 quantity or 20 quantity of a particular securities, so you have to decide that how much quantity are required to take. So you have to manually put that amount of order quantity. So in the order quantity field, you have to put an order quantity, and based on that the trade will execute. And fourth very important is price. At what price you have to place an order of that particular security. Now there are two different ways in which you have to place an order and price for a price. So you can place an order through limit price, or you can place an order through a market price. Now what is limit price? So when you say limit price means you will manually enter a price at which you want to enter into a stock. Say for example, the stock now currently trades at 100 rupees. Okay, and now you want to buy that stock at 98. You're bargaining, right? So in the limit price, you're bargaining to buy a stock. Definitely, if you're a buyer, you will bargain for buying at a lower price. So if a stock is trading at 100 rupees, you will buy a stock. If you will put a limit price at rupees 98. That means I want to buy a stock, let's say 20 quantity at 98 rupees. Now currently the stock is running at 100 rupees. and you have to buy at 98 rupees, then you have to place a limit price order at 98, 20 quantity at 98 rupees. Now, once this price will cross to 98, your order will get executed into a trade. That means you have bought a share of 20 quantity at 98 rupees. But if you're placing a market order, the market order, your trade will execute immediately. So once you place an order, it will execute immediately at whatever price that particular stock is been currently running at. So if it is trading at currently at 100 rupees and you place a market order, 20 quantity at market order, okay, at market price, that means your stock will get executed immediately at 20 quantity at 100 rupees. So you do not have any bargaining power. So you have to decide that I have to place a limit price or a market price. What is the difference between what happens when you place a limit price, a limit order, or a market order? In limit order, you don't want to execute that particular trade immediately, right? You want to do a trade at a later point of time or at the price at which you want to trade at. You don't have any news or something on that particular stock. But if you have certain news in that stock and if you want to execute it very immediately, okay, then you have to place a market order. So market order helps in execution of the trades immediately, whereas in limit order, you don't want to execute it immediately, so you will place a limit order. So these are the ways in which you can. This is the broker terminal. Basically, on the right hand side is a broker terminal where you will have to search a stock that you want to trade. So the name of the stock is here. Now let's say here the name of the stock is Tata Steel. So you want to buy a stock of a Tata Steel. You have to search Tata Steel there, and you have to see at what price it has been trading at. Okay, what is the technical chart of that particular stock has been looking like? What are the fundamentals of that particular stock? All details will come there in a broking terminal. This is the way in which the price is open. This is the high of the this is the high price of the day. This is the low price of the day. All details will be available of that particular stock in the broker terminal. Based on that, so once you put a Tata Steel, then you will get all the description of the trade order, right? So once you selected the name of the stock, then you have to decide in which exchanges you want to trade it, whether you want to trade on NSE or whether you want to trade on BSE. Now both the exchanges helps you executing the trade, right? But there are different transaction charges that both exchanges takes. NSE takes higher transaction charges as compared to BSE because NSE provides higher liquidity. The liquidity in the stock exchange is higher. That means the execution happens fast and transparent manner. In BSE, the execution will happen slow because the liquidity is lower, and therefore they charge your lower transaction charges. So therefore, you have to decide on which exchanges you want to execute a trade, whether you want to trade on NSE or whether you want to trade on BSE. You have to select exchange where, on that selection you have to do whether you want to do on BSE or NSE. Okay, and the price sometimes also differs. Some 0.25 or 0.15, the price will be here and there. So sometimes you will get a cheaper at BSE, sometimes you will get NSE cheaper price based on the demand and supply of a stock. Okay, so this Tata Steel stock is currently trading at 364.75. This is the current market price of a stock. Now what you want to do, whether you want to do a buy or whether you want to do a sell of a stock. So if you want to do a buy, if you're a buyer, you will buy a stock, or if you're a seller, you will stick. So you will again click on that whether you want to buy a stock or you want to sell a stock. Okay, so you have to select to buy or sell of a stock. Then product type. What do you mean by product type? The type of trade that you want to take. If you are an intraday trader, you will select an intraday trade there. And if you want to hold this position for over a period of time, you will select a cash system, CNC, or cash on carry trades. You will select here. So there are two options which will be available in the type of trade. Either it will be a cash on carry trade or either it will be an intraday trade. Again, the margins will be different. You have to pay a different margins for intraday trades. You have to pay different margins for a cash and carry trades. So we have to decide whether we want to take a risk or we want to take not to take a risk. and based on that you will decide which type of trade you want to take. Then you decide on the quantity also, and along with the quantity you decide whether you want to enter the price or whether you want to place a market order. Okay, so if you want to buy at a current price, you will immediately place a market order, and if you want to enter at a price at which you want to decide by you want to bargain that particular stock, if it is running at 100 or bargain at 98, you will place 98 rupees here, and based on that you will decide which order, what type of order you want to place, limit order or a market order. Side in that you also get market depth, the entire order book of a particular stock. So on the live basis, or in the broker terminal, on the live basis, you will get the live rates or live feeds of that particular stock. So here if you see a bid quantity means the buy order quantity. So there are 735 order quantity which is pending at a price of rupees 364. Okay, at a 364, the price is currently running at 364.75. Now a buyer want to buy a 735 quantity at 364.70. So 75 rupees much it's running. They have put a buy order at 70.70 at a low. So they're bargaining that particular trade. Okay, they're bargaining, but they want to buy a 735 quantity at 364.7. This is the buy side. A buyer wants to trade. Then there is the sell side, which is called to be an ask quantity. Ask quantity means a seller. A seller wants to sell a 315 quantity at rupees 365, which is higher than what the current market price is running. Of course, the seller wants to sell at a higher price at what the current market price has been running at. Then only he will earn a profit on it, or he or she will earn a profit on it. So this is how the order book looks like. So if you see a buy order book, a buy order book is nothing but in the it will be in the 364.7, then it will get lower, and lower. Whereas in the case of the sell side book, if you see, it will get higher, higher. So 365, they will get 365.05, 365.1. So it will be on the ascending side. So it will get increasing. Whereas in the buyer side, it will get declining because of the buyer, and then only the buyer and seller meets and the trade get executed. So this is the market depth. So generally, and in normal investors who are retail participator will get a 20 market depth, 20 orders which are lying in the order book currently. So these are five, 1, 2, 3, 4, 5, 6, so 5 order depth. So generally, you will get to see the normal market participants will be 20 market depth is visible in the broker's terminal. You can look into the, because the total quantity that are on the buyer side is 101811, the total quantity which a buyer wants to buy, and total seller quantities is 10. So this is a total quantity which are there in that particular stock today's liquidity in that particular stock. So this is generally how one can buy or sell a particular stock. This is called to be a broker's terminals, where you have to make various decisions before start investing or start trading in the market. That are name of the stock, the quantity at which the quantity that you want to trade, which exchanges you want to trade, at what price you want to trade at. So these are all the decisions you have to make, whether you want to sell or buy a particular stock, and what type of trade you want to take, whether you want to take intraday or whether you want to take cash and carry trades. So these are the various decisions you will be required to take while trading in the market. Now, once you start trading, what is the way, what is the cycle, okay, which happens when you execute a trade, right? It is not that easy. So, for example, if you have buy a particular stock, whether you will receive that stock on the same day, the answer is no. You will not receive the stock on the same day. Receiving means whether it is credited on in your demat account on the same day. The answer is no. There is a cycle called as T plus 2. T plus 2 means trading day plus 2 days more. So on the trading plus 2 days more, that stock, whatever you have bought on trading day, will get into your account, into your demat account. It will be credited in the third day. So that is a T plus 2 settlement cycle, we call it as. So once you have started buy that particular stock, let's say on 16th April today, then it will get in your account credited, means today 16th April plus today 17th and 18th. So it will be credited on 18th of approach. This is what the T+2 cycle talks about. So T+2 is nothing but a settlement cycles which you have bought today. It will not created immediately. Like in the banking part, when you have given an amount to someone, you're debiting or crediting an amount to someone, it will happen immediately within a seconds, or if it's a big amount, it will happen after some time. But in the case of securities market, it will happen on T+2 basis. That is called as a settlement cycle. Okay, so once you execute that particular trade, the buyers and sellers enters into a legally binding agreement to transfer securities from the seller to the buyer in exchange for money from the buyer to the seller. So they become, so once you buy a particular trade, you become a legal binder that you want to buy a stock that will be credited in your account, and you have to give that money to the seller. So you will become a legally binding, and that's the way the execution will happen. Once you execute a trade, then it will go for a clearing purpose. Okay, and that clearing purpose will then look into performing all of the necessary steps leading to the settlement, such as posting sufficient margin and recording the transaction. What does the clearing do? Now, who does this? Execution will be done by the broker terminal, right? Once you put an order, it will be done by you manually, and then the brokers will execute your trade. Now, in execution also, it's not that easy. We'll have a discussion in down how the executions will happen. What are the risk management tools that a broker has while you execute a trade? So while you execute a trade, there's multiple limitations that a broker has. Like if you, let's say, as we're talking about the price band, right? If a stock is at 100, you cannot place an order, and if the price band is 20%, you cannot sell a particular, or can sell a particular securities more than at rupees 121. If the stock is at 100 and the price band is 20%, you cannot sell it at 121. You can sell only till 120. So this is risk management. Your order will get rejected, right? So it will not execute. So the execution also has various conditions. After going to that conditions only, the trade will happen. Otherwise, the trades will get automatically rejected by the at the broker terminal itself. So one is about circuit. The other one is you have a sufficient fund in your account. If you don't have sufficient fund in your account to buy a particular stock, then it will automatically reject it, saying that an insufficient fund margin. You do not have sufficient fund. So these are various multiple risk management tools that a broker has to keep. Also, there is also one ways in which you cannot do a intraday trading in a stock. Okay, so if a particular stock is into trade to trade category means a category of a stock where you cannot do an intraday trading. This is being done by a stock exchanges. They put these trades, these scripts into a trade to trade category. So if you're doing intraday trading in that, the stockbroker will reject those trades, stating that this stock is into the trade to trade category. So if a stock is into trade to trade category, you cannot do an intraday trading in that stock. So again, it will get rejected. So these are the multiple checks and balances that the broker has once you execute a trade into it. So there are other than this, there are also various multiple things that you have to keep in mind while trading. And if that particular conditions are not fulfilled, the order itself gets rejected at the broker terminal. It will not go further to clearing. For example, let's assume that if you have a if you are selling a particular stock, say Infosys, okay, a 10 quantity you are selling, and in your demat account you only have 5 quantity, okay, only 5 quantity, and you are not holding any stock more than 5, but you want to sell a 10 stock. Can you sell it? The answer is no, because it is not there in your demat account itself. So how you can sell it? In intraday it is possible. In intraday you can sell first, you can buy later. But when you're doing a cash and carry trades, you cannot sell more than what you have. You can only sell 5 stock, you cannot sell more than 5. So again, it will get rejected stating. So if you're placing a CNC order and you're selling 10 stock, when you only have 5 stock in your demat account, the order will get rejected stating that you do not have sufficient stock in your demat account. So these are all the checks and balances. But if you're an intraday trader and if you place an intraday part there, then in that case, if you are buying a 5 stock, if you can sell a stock first and later in a day you can buy that stock back. So this can be done, but shorting cannot be done beforehand in while doing a CNC trades. But while doing an intraday trades, you can sell a stock first, later on you can buy a stock. This is how the execution happens. So you should know all these things beforehand while trading, because it's a very important thing that you have to have multiple risk management tools. So now, for example, if you are doing an intraday trade, assuming you are doing an intraday trade, okay, and you are selling at, you're buying a 10 stock, let's assume. Now you have to square off that trade, 10 stock, you have to square off it during the day, right? Now, if you buy at say 100 rupees, okay, and the stock is not getting over at 101, 102, ho hi nahi raha. That is, the stock is not moving at that range. It is just moving at lower, 98, 99, 97, 96. That rate is not coming. Okay, it is not going above 100 because you want to sell a stock at what you have bought at. You have to sell it at above that price. So if you have bought at 100 rupees, you want to sell it 101 or 102 or 105, but that price is not coming in the entire day during the day. Okay, now at 3:15, okay, at 3:15 the market closes at 3:30, right, and it open at 9 o'clock. So there are again 9 o'clock to 9:15 there is a pre-open market, and from 9:15 to 3:30 there is a market that is actually run. Okay, so pre-open market where you can place a bid. Okay, place a bid, so you can place a buy order, you can place a sell order, but will not execute. It will only execute after 9/7. So 9 to 9/7, there where you can place up bids for buy and sell, which is called as a pre-open market. And after 9/7, you can your trades will get executed. Okay, on the other side, and then after 9/7 to 9:15, there is a break on the market. There is no activity that will happen. After 9:15, that normal trading starts. So this is called as a pre-open market and then the normal market. So in the pre-open market, it is again divided into 9 to 9/6. 9/7 is an execution, and after 9:15, your normal trading starts. So from 9/7 to 9:15, there is nothing. Nothing happens. So from 9:15, your normal trade happens. Okay, and you have placed an intraday trade. Okay, you buy a stock at 100 rupees, and the price has never come to that level. Okay, it is never crosses 100. Now you want to sell a stock. What you will do? Your intraday, you have placed an intraday order. Now in that case, from what does a broker tell me? So every broker will have its own rules and regulations. So what this broker will do into on and themselves, they will sell that particular order after 3:15 to 3:20. They will sell your or trade at whatever current market price has been running at, because you have not sell it off into your own self manually. You have not placed a sell order. They will execute at whatever price is running at, and they will sell it off, but they have to clear it off. They have to sell it off the same day because you have placed an intraday order. So if you have placed a cash and carry, then you can carry that particular trade over the next day or over a period of time. But if you place an intraday, it has to be executed on the same day, even though it is a loss. So therefore the risk in the intraday trading is high as compared to cash and carry trades. So these are the various risk management tools that particular broker has to go before execution of a trade. Then the trades will start clearing off. Now when you go for a clearing, okay, then the clearing will then look into, so this will go to a clearing member. Okay, so the trading member is different, the clearing member is different. Now all the risk and balances has been checked by the broker, okay, the trading member. Now it will go to a clearing member of the broker only. So it will mostly, the clearing member will be a part of the broker only. Okay. So for security or for the cash market, it will generally the same clearing member who is the trading member. So it will go to the clearing member. There is a different intermediary altogether, a clearing member who will look into your trades also and to the seller trade also. They will check whether they have sufficient margin altogether, and they will record the time of the transaction, at what time the transaction has happened. They will all record in their accounts, and they will perform all the necessary steps that they have in their criteria, that the sufficient quantity is there, sufficient margin is there, there is a particular amount, the transaction has been properly recorded at the same time, and everything they will check. So there, once the clearing will happen, it will go for a settlement with the settlement team. Now what is the settlement? So this will go now from broker end, from trading member to clearing member, from clearing member to the national clearing corporation. Now there are two different clearing corporations in India. One is with NSE and one other one is with BSE. So there is a clearing corporation of India and there is a national clearing corporation of India. So this is called NSCL and CCIL. So NSCCIL is held by NSC, and CCIL is being held by BSC. So all the trades which are executed, okay, now we'll go for a settlement, and the settlement is done by the exchanges, clearing corporations. The clearing corporations, which are called to be a clearing corporations, are called to be clearing corporations. So when we go from trading member to clearing corporations, and there the settlement of the trades happens. There the actual exchange of securities will happen for money when the securities are titled to the buyer and the money is transferred to the seller. Now the securities will then go to the demat account of the particular buyer, which is done by the depositories again. So once the settlement happens, it will go to depositories, and then the depositories it will happen debit and credit of a stock, and the amount will get transferred. The amount will get transferred immediately, but the securities will become under T+2. So because of such a lengthy process, your stock, whatever you have bought, will only settled after T+2. So this is why it takes a lot of time, because it moves from broker to clearing member to settlement and then to depository. So these are all the ways in which it takes time, and therefore it is called as T+2 settlement cycles. So the settlement happens once you trade an order. Okay, the brokerage house and risk management check that we have seen now till now. What are the different risk management check that they have? You can put only at that price. You should have that much quantity to trade. So there are multiple checks that a particular broker has. So you have to pass through all those risk management checks of the broker. Okay, so once you trade, if you fail to do that, then the order gets rejected. You will not be able to trade. If it passes through, it will start finding a match. So then your order will come into the order book. We have seen earlier the order book, right? The 5 orders that we have seen in the order book, it will reflect there in the order books, and they will start the seller will start finding buyers will find standing will start searching for a seller. So this will happen, and then they will find a match. So once the match happens, there will be a confirmation of the trade that you have traded for this much quantity of shares for this much, and then the post-trade process will start. That means the clearing and settlement will start. Then it will go. So once it will go from broker to clearing member, then it will go to the clearing house. So the clearing house will then start the settlement of trade, which is called to be an NSCCL and CCL will clear your trades. So this is done by the clearing house. So these are the two clearing houses that we have in India. And how does the broker terminals looks like? So the broker will look like this way. Your orders will go to a front office of the broker. Okay. Now it will go to a front office, and front office, what they do, they will capture the trade. Okay. Once they will capture the trade will go to the middle office of the broker. And what does this middle office of the broker will do? They will do a validation of the order, whatever you have placed an order. So the orders will capture in the trade and the front office of the broker. This trades, once captured, will go to a middle office of the broker, and they will validate the trades, whether this particular order is properly been put or not. They will validate that. Once the validation has been done, they will do a booking of the trade, a booking of the order, and the booking will be done in the order book by confirming that you are the buyer or seller. So that will be reflected in your order book. So when it has been reflected in the once it is reflected in the order book, then the trade will happen, and the confirmation of the trade will pass to the investor who wants to invest. So who have invested in that stock. So either it is a seller or a buyer, you have sold a particular stock at this much rate, this much quantity at this much rate, or if you're a buyer, you have traded this much stock at this much price. So the confirmation will go to the buyer or a buyer and seller on their mobiles that this is how much you have traded and this much is the value that you have traded today. So this is a confirmation that will go back through the brokers through an SMS. So this is done by the middle office of the broker by validating the order, by booking the order in the order book, and by confirming the trade to the investor. Once these trades happen, it will go to the back office, and the back office role will be what? It will be clear the trade will go to the clearing member, then it will go for a settlement with the settlement means with the clearing house, which is two NSCN basis. This is done by the back office. This is called to be a back office operation, and then it will be done by an accounting and finance. Accounting and finance means the money flow. The money flow from one account to the another account will be done by. So these are the back office work. The front office work is to capture the trade. That means to capture the order, whatever the order has been placed. The role of middle office operation is to validate those orders placed in the order book and confirming the trade through an SMS to investor. And the role of back office is nothing but the clearing the order, clearing the trade, whatever you have traded, settling that trade through a clearing house, and moving the flow of money and flow of money into the account. This is the role of an accounting and finance. So, and this is how the trade is get executed. Now, these are the three important institutions which plays a very important role along with depositories. So there are custodians. There are custodians in India. There are private custodians. There are public institution custodians. Now, what is the role of custodians? Custodians are nothing but they are the holders of the, so whoever, like a large investor, like a foreign investors who generally wants to trade. Okay, they don't. There are always a custodians. Okay, who takes a guarantee for the foreign investors. So if they want a particular trade, the margins and everything will be looked, the settlement and clearing will be done by those custodians. So these are different entities for a large investors, which are foreign investors or which are very high net worth investors who wants to trade in Indian markets. So these are overlooked by custodians by providing guarantee to the exchanges that we are taking guarantee for these investors. Please allow them to trade. So these are the role of the custodians. So there are multiple custodians in India. There are public institutions also, and there are private institutions also, who takes this role of clearing the trades on behalf of foreign investors or high net worth individuals. So they do the role for, because the value amount is huge here, and since the value amount is huge here, generally the normal members, clearing member does not take that responsibility. So it will place on the custodian. The custodian plays a very important role in regard to the large value transactions. Clearing firms, we have already learned about clearing members. So each clearing members will have their own clearing member, and commercial banks. So commercial banks is nothing but a settlement banks. So if a particular member wants to get registered, the execution of the trades, so each broker has its own bank and they will place margins to it. The clearing corporations of exchanges will have control over the member trading members banks. They do not have control over each and every client's control. That will have by the trading member. The clearing firm of the member will have that hold on that. So the clearing corporation will have hold on the trading member. Trading member will have hold over this client. Okay, so clearing member will hold on the member bank account. So member, when a trading member when gives account details to the clearing corporations, the clearing corporations will look into the brokers whether they have sufficient margin or not for trade, and the broker will overlook the bank account of the each and every client that they have. So this is the commercial bank operations. The banks also plays a very important role in execution of the trades. So this is generally a trade cycles which we are talking about while trading. So these are therefore the settlement cycle takes a T+2 because there is a lot of process that happens in the back office, middle office, or a branch, or a back front office. So because of all this and various intermediaries that are playing a role while executing the rules. So as an investor, we are not worried about all those things. We are just worried about how our trade get executed, at what price we have got, at what quantity we have got. So we are more interested in that rather than rather than we are interested in knowing about these about this about this thing till now. Okay, so we are not more concerned about how the back office functions or how the middle office functions, but we are more concerned about whether our trade get executed or not. So when you are executing our trade, so you keep in mind that each securities at which price band they are at, whether they are into a trade to trade category or not. Okay, and because when can we do intraday or not will based on the whether in which category this stock has been falling into. So if the stock is falling into trade for trade category, you cannot do intraday trading then. At what price band that stock is. So if that price band is 5%, you can move up or down only till 5%, not more than that. So all these things has to be kept in mind while trading, and therefore then validation will happen. So we are till now worried about that, whether we have sufficient margin to trade, how much quantity to buy. So we are worried about that part. So we are not worried about how this clearing and settlement generally takes place in the clearing corporations or the clearing member and how the custodian depositories function. But generally, you have to keep in mind that whenever you buy a particular stock, it will reflect in your demat account only after T+2 basis. This is a settlement cycle which has been taken place. So I hope this is very clear to you. Now, why we invest in stocks? So there are multiple reasons why you invest in stock as an investor. You represents ownership in a firm, right? So once you buy a stock, so till now, whatever we have learned about equity market investments, right? Talking about primary market, talking about secondary markets, how the stock exchange functions, and and how the cycle functions and how you can place an order. We are all learning about equity, right? But till now, whatever we have learned is about equity market as an asset class. So whenever you want to invest into a market, you're talking about here equity markets. So when you talk about equity markets, why one has to invest in those equity markets? And it's in equity and asset classes. So when we're talking about why one should invest, they should invest to beat inflation, to accumulate the wealth, to meet their aspirational goals, right? So where you will invest, you can invest into bonds, you can invest into equities, you can invest into real estate, you can invest in commodities, you can invest in real estate, private equity investors, hedge funds, you can invest in multiple instruments. But now we are talking here about equity markets. Till now, what we're talking about primary market and secondary market and transaction cycles. We're talking about the equity markets here. So when you invest into those stocks, you become a part owner of that firm, right? And you earn a return in two ways. One, you earn into one you earn an amount of money by way of appreciation of a stock. So let's assume you have taken an Infosys stock at rupees 1300, or today's price I think it's 1400 or something on. So if you're buying a stock at 1300 rupees or one stock at 1300 rupees, and the price over a 6 months period have gone to 2000 rupees per stock, that means 600 is what you have earned over a period of time. That 600 is nothing but is your return, and that return is nothing but a way in which your capital gets appreciated, and that is the return that you are expecting from equity market for investing in equity. And second, also it's nothing but a dividend that you will derive from investments. Okay, so what type of form of returns that you will derive from dividend? So what is dividend basically? Dividend is nothing but a part of the profit that a corporates will provide you because you have invested in their stock. You have reposed the faith in them, okay, on the company. And you repose the faith on the company, and the company is doing very well, and they have a huge profit. Then they will pay to the shareholders in the form of dividends. Dividend is nothing but on the face value of a stock. So let's assume your face value of a stock is rupees 10, and they're saying that I am paying 100% dividend. That means they are paying you rupees 10 per share. Okay, so that means they are paying you a dividend of rupees 10 per share. So if you are holding 100 shares, you will get 10. So in 100 into 10, you're getting 1000 rupees of dividend. Now this dividend can be of two forms. Dividend can be an annual form or it can be an interim form. It can be declared. So we'll have a detailed discussion on the corporate actions where we learn about how the dividend is being paid to our stockholders. Okay, so they get two ways of return. One is the way of by way of rising of a price, and second is way of a dividend which are paid to a shareholder. Now you have to pay taxes on it. The government takes taxes on your capital appreciation. So if you have sold it within a 1 year period, then you have to pay a tax or as called as a short-term capital gain, that is 15%. So whatever return that you have earned, you have to pay on that 15% tax to the government. And in case of long-term capital gain, if you have long-term capital gain is nothing but if you are holding more than 1 year, that means you have sell, or if you buy a stock today, and if you have sold it to the next year or more than next after 2 year or 3 year, then it is called to be a long-term capital gain. And that long-term capital gain is nothing but a taxes if it is if you have earned it more than 1 lakh rupees, then you, over a period of time, over a period of year, then in that case you have to pay 10% of tax on it. So if you're holding a stock for more than 1 year, you have to pay a lower tax or no tax. So if you are not earning more than 1 lakh, then in that case you are not required to pay any taxes to the government in case of long-term cap, if you're holding for a long-term period. But if you're holding for a short-term period, you have to pay a 15% tax to the government on the return that you are earning. Also on dividends, dividend that the company gives you, on that also you have to pay a taxes to the government on whatever the slab you're falling into. So on both returns you have to pay taxes in each and every return, whether it is you are investing in the real estate, you are investing into gold, or investing into a private investor. On every return, whatever you are, if you are earning it, you have to pay taxes on it. Only exemption is the long-term capital gain over under rupees 1 lakh. If you are earning 1 lakh less than 1 lakh, you are not required to pay any taxes to the government. Other than that, on bonds, on gold, on real estate, on private investment, everywhere you have to pay a taxes to the government, whatever return that you have earned on the amount. So always you have, when you are looking for a return targets, you have to always look into post-tax returns. You should not always look into pre-tax return, because post-tax return is very important to determine your goal aspirations, how much wealth you will accumulate over a period of time will only be depend, because some part of the return you have to give to government and some will be kept by you. So when you have a certain goal of wealth, then you have to always take into consideration post-tax wealth. Okay, that will meet your goals. Otherwise, after a 5 years, you will say, "Oh, my target has not get fulfilled, and I cannot achieve that goal." So that will not be a so that should not be a case. Stockholders should have claim on all assets. Okay, so once you become a part owner, you have claim on all the assets of the company, whatever the company has an asset. But again, that is a different way. So if you are again, there is a different in our Indian regulations. If a corporate gets default, let's assume the corporate gets default and you're holding a share of that default company. Okay, now that the company is not going to run in future, it gets liquidated. Then there is a certain ways in which the assets can be used of the company. The first person who will receive the assets of the company, now let's say the company is not operating, right? The company gets liquidated or wind up. They don't have money to pay to anyone. Now, not even the equity holders, not even to the debt holders, not even to any preferential. So what we have to do it? We have to sell off all the assets that the company currently holds. So in that case, it will first go to the borrower, to the lender who have lent the money to the. So the first priority will be given to the bank, public sector banks. So all the assets will be sold off, and whatever amount the money that I have taken, borrowed money, that will be mitigated by way of selling the assets, and it will go first to the banks. Okay, once it goes to the banks, then second investors who will get that money is to the by the debenture holders or the bond holders who have invested through a bond. Okay, they will get the priority. So the first priority will be get to the bank, second to the bond holders, third will be the preference holders, and fourth will be the stockholders. So the equity holders who are invested in the stocks will be the last one who will get the money in case that the corporate gets default. So if the corporates get defaulted, the first priority will be given to the bank from whom they have raised the money. Then second priority will be given to the debenture holders or the bond holders. Third priority will be given to a preference shareholders who have taken on a preference basis the share. And fourth will be the equity holders. Last will be the equity holders who will receive the money if any left out. And also after the borrower, there is also creditors who will get the money. So any creditors of the suppliers who have given them the goods or services on a credit basis, they will get priority over the equity holders. So we are the last one. So therefore, we say it's an equity investment is a riskier investment, because one is the prices get fluctuate very often because they are regularly traded, the high liquidity, and also the chances of getting default by the corporates is also very high in case the company is not doing very well. And the last one is the right to vote. Now we as we are becoming the owner, we have a claim on the assets also, and also we have a right to vote on very important decisions that a company takes on a day-to-day regular basis. Okay, so each and every holder of equity shares has a right to vote on a business matter. So company will have a meeting, annual general meeting or a special resolution meeting. So on those meetings, they will call all the shareholders, or call means they will not call, they will give an e-voting facilities to the shareholders that we are deciding on this matter, please vote electronically at your home itself or at your office itself. You just have to click whether yes or no, whether you want that business matters to go ahead or not. So whereas, for example, if I appoint a chairman of a company, one chairman is resigned and the new chairman is required to be appointed, a shareholder has given a power to vote whether you are accepting the appointment of the new chairman or not, or any other business matters, whether it's about raising the finance or any other matter, whereas shareholders will be given a vote, given a right to vote on those matters. Now, why this vote matters? Because if a particular business matter is very special to an organization or company, at least 75% vote is required. Okay, only if you receive a 75% vote, then only that matter will go forward for the company. Otherwise, the matter will not go forward for the company. So therefore, the votes matters. And in case of special matters, it really matters because it requires 75% voting. In case of ordinary, you require 50% of voting, which is generally being held by the promoters of the company. So there is no concern. But in case if it's a special matter, then in that case, you require at least 75% voting by the shareholders. Then only that matter will go forward for the resolution of the company. So these are the ways once you invest in the stocks, you get a lot of power, but along with the power, you also get a lot of risk that you are taking while investing in the stocks. So power in the form of vote, power in the form of return, power in the form of claiming the ownership of the company. But return risk is in the case of default, or in the case of pricing highly fluctuating, or the company is not giving any dividend in future, and in that case, that is considered to be a risk. So this is what we have today talking about the equity markets, how this equity market generally functions, and how they are being traded in the markets, how we trade in the market, how is the clearing and settlement process takes place, basically the transaction cycle of the equity markets. So we have learned all throughout this 3 hour session, we have learned about equity market in detail and about different primary markets and secondary markets. And also we have learned about how this transaction actually happens on the backend part and why we have to invest in, and we also learn into various risk and return characteristics of different asset classes. So this is what today's session is all about. Paresh,
Yeah, thanks, Chirag, for your session. So there was one question about the hedge fund. So you can explain on the hedge fund, what is the use of the hedge fund, and how the hedge fund will benefit, by Gopal G.
Okay, Gopal. So basically, hedge funds are generally been done by. So there are different hedge fund managers in our country in India, but they are not very famous in India. It's largely famous in international markets. In India, we have a very low counts of hedge fund managers, but this hedge fund is generally been invested by high net worth individuals who have a huge amount of wealth. They go to an hedge fund managers and they say that I want to invest this much amount of money into the markets. So basically, this hedge fund managers, what they do is they take a pool of investments from this high net worth investors. They take multiple they will meet multiple investors, high net worth investors, and they take all their money. They pool into one strategy. So what this hedge fund managers has is that they have different strategies with their in their place. So based on the risk return characteristics of each and every investors, they will decide that they have to put this money. It's like a mutual fund, right? A mutual fund where they're pooling the investments amount of money. This hedge fund managers also pool this investments money, but they put their money into a strategy that they have formed, and not in the mutual fund like they put into stock. Here they put this money into the derivative strategies, different multiple strategies, option strategies that they have, like butterflies, multiple option strategies, multiple future trading strategies. So they will put those money into that, and that is of huge amount of value. So they can also take leverages. So they are generally doing a leveraging trading. They take borrowed amount from loan amount and they do that amount of trading. They do a shorting of the trade through SLBM market, securities and lending borrowing market. So there are multiple ways, strategies that they form, and based on those strategies that they trade. So the complex strategies they form, And based on those complex strategies, this hedge fund managers actually function. But very few hedge fund managers are available in India today. And also these investments are done generally by the high net worth individuals, not as a normal retail participation will go to a hedge fund managers, because they charge huge amount of fees as well. So that's why it's not very popular into the retail participation. So yeah,
Okay,
Paresh, I hope.
thanks. There is one more question about what exact is a Wall Street
Wall Street.
by Adarsh Singh.
Wall Street, right?
Yeah.
So Wall Street is nothing but it is described in the it's the street which called like we have a Dalal Street in India where the BSA has been traded. Same way in United States of America, there is a Wall Street where it's an area where the stock exchange has been there. So this is called to be a Wall Street. So there's nothing else like Dalal Street in India.
Okay. Thanks. There is one more question about how any publisher that publish circuits can investor of primary market participate in the secondary market. So
No,
how
I
the
didn't get
circuits
it.
has been decided?
So how circuit is decided?
Yeah. Who published that circuits?
So circuits are basically a price bands. So these price bands are determined by the stock exchanges. Now this has been determined. So each and every stock which are listed on the stock exchanges will have different price bands based on certain set of criteria that are available in the stock exchange websites. You can just go there and can find out the different criteria that are there to determine the price bands for each stock. Based on that criteria, if that particular criteria fits that particular stock, then they will become under that 5% band. So there are different circuits, 5%, 2%, 10%, and 20%, in which that stock will only move. It will not go beyond that. Only for derivative stocks, there are no circuits, there are no price bands, but they have the circuits like 10%. After 10%, they will start flexing it to 10, further 10%, 10%. So they don't have that price bands, but they have circuits, but it will move on. So that's fluctuating one, flexible one. But in the case of stocks which are non-derivative stocks, there are price bands that are decided by the stock exchanges based on certain parameters that are publicly available, and based on that only you will be trading. The stock will move in that particular range. Yeah, Paresh.
Thanks. There is one more question by Adarsh Singh. Adarsh Singh, you can ask your question. I have given you the access for unmuting.
Hello.
Yeah, Adarsh.
Good evening, sir. Sir, my question was that is there any link between chartered financial analyst and stock market?
Sorry, which one?
Financial analyst, CFAs.
Uh-huh. And
There
link
is
in
there
sense?
any link between them and stock market?
No, link in sense what? Link means what type of link you're
Uh,
saying?
like,
Can you,
is the role of financial analyst? Is there any role of financial analyst in stock market?
okay, you're talking about career perspective, right?
Yes, sir.
Yeah, so on career perspective, yes, definitely, because CFA talks, it's a syllabus which all talks about the hello, hello, Paresh, can you hear me?
Yes, yes. Now we can hear you.
Yeah.
Your voice was left. Yeah.
Okay, so CFA definitely helps because CFA's role is generally syllabus of CFA is basically is about how you will have to research a stock, how to find a value stock, how you can find a low value stocks, and based on that you have to decide on. Also, they help us to understand what are different types of jargon which are used in stock market, how stock market functions, and strategies that can be deployed to earn alpha in the markets. So basically, there is definitely an help to it, and also CFA gets a certain designation by a regulator. Also, SEBI also provides a high place to CFA people because they can advise for investment. So they becomes the investment advisors for multiple retail participation, for FIs, for foreign investors. So this helps them. So CFA really helps in uh, helps into the investors to invest, helps them to guide the investors to invest in securities market. Generally, there will be an investment advisors, or you will get a role in the securities market somewhere or other. But definitely there is a link between the CFA and equity markets.
Okay. Thanks, Chirag. Any questions? If anyone has, kindly raise so we can give you the access to unmute.
Hello.
Yes, go
Hello,
ahead.
yeah.
Sir, how to pick up stocks?
Okay. So how to pick up a stock is not a direct straightforward answer to it. But yeah, you can find out to fundamentally you have to research a stock, whether that particular stock. So you have to do there are three ways in which you can research a stock when you want to pick a stock. So you can do a technical analysis. How the so this is basically technical. When you say technical analysis, is basically not but a historical movement of the price and volume. So you have to check how the price of that particular stock historically been moving over a period of time, historically, like what is the volume which has been traded in the markets. So there are various signals there, technical signals or technical indicators, which says that you are that the stock will move further up or the stock will go up, which is not always correct because it's historic. It's based on historical patterns, which does not predict the future. But based on that, you can indicate that the stock will move up or go down. The second one is a fundamental way of selecting a stock. So there are two different ways. One is a technical and the second one is a fundamental way. When we talk about fundamental way, then it is about reading the balance sheets, reading the profit and loss account, reading the cash flows of the company. So based on that, you will decide that whether the stock is undervalued or overvalued. So what do you mean by undervalued or overvalued? When you say undervalued, it means that a stock which is currently, let's say, trading at 100 rupees, but when you have calculate the intrinsic value of a stock, it is showing at the intrinsic value of the stock should be around 90 rupees. That means the stock is currently overvalued. So you should not buy a stock because it's already overvalued in the market. But it can be possible that there can be an announcement that the company is doing very well in future, it will do very well, so therefore the stock is trading at higher value. So you have to look into the management of the company, what are the news that are flowing in the market for that particular stock, or how the management is so you have to do a bottom up approach while selecting a stock. So while selecting a stock through fundamental manner, so you have to do management background check, you have to do all the financials of that company, you have to read the annual reports of the company. So this is that is a fundamental way of analyzing the company. So in this way we can select a stock. So one is a technical approach of selecting a stock, the other one is a fundamental approach of selecting a stock. So there are two different methods of picking a stock.
Okay, thanks. One more question is, what is more beneficiary, long-term trading or day trading?
No, so it's all depend on the investors. So if an investor is ready to take a higher risk, they want a higher return, they can do an intraday trading because the margin is less there. And if a particular person is a long-term investor, so it all depends on the investor to investor. If a particular investor wants to have a certain long-term goal or a mid-term goal, and he wants to fulfill that goal, then he can do a long-term investment in a stock. Or if he feels that a stock is a long-term bet, okay, that stock will do a good on a long-term basis and not on a short-term basis, then he can invest some amount of money there in a huge amount or some amount of money in the long-term basis. So it all depend upon the investors to investors risk and return ability that he can take.
Thanks, Chirag.
Yes, ma'am.
One more question from Sarmal. This will be the last question, so we will be closing
Okay.
the session. You can ask the question, Sarmal. I have given you the access. Okay. What is Nifty? Has been asked by Nayal. What is Nifty? Yeah.
Okay, so what is Nifty? Basically, we will have coming slides over a day. Next, I think so. Tomorrow we will be having a discussion on what is Nifty. So Nifty is nothing but a stock market index where there is a constituent of 50 stocks. So these 50 stocks will come together and will form an index. Now the price of those stocks will determine the price of the Nifty. So if 50 stocks all will be in the upper or all in the bullish mode, the Nifty will go up. If some of the stocks will go up, some of the stocks will go down, the Nifty will also be on the sideways manner. It will be a flat. So it all depends on, so each stock will represent some part to it to the index. So some of the stocks will have a higher weight, some of the stocks will have a low weight. It will all depend on the market capitalization of the stock. So we'll have all detailed discussion later on. Tomorrow we will have tomorrow or day after tomorrow we have a detailed discussion on how the Nifty has been formed on. So we will have a discussion on it. It's a combination of 50 stocks basically.
Okay. Thanks, Chirag.
Okay.
Thanks everyone for listening patiently. Tomorrow we will be starting the session with the same link at 6 p.m. Thanks everyone.
Okay. Thank you all. Thank you.